Good morning, and good morning, everyone. You're welcome to today's webinar organized by the Securities and Exchange Commission on non-interest capital market products for the pension fund industry. It promises to be a very good session, more engaging, interactive, and we have papers that will be delivered by people that are technically competent, not just intellectually, but based on their experience of creating or running different products that will be quite relevant to our discussion today. We have speakers have joined and different heads of agencies who will be giving us different goodwill messages as we go along. We plan to stay right on time. We want to make maximum use of the executive time and the intellectual engagements which will be occurring during this session. On that note, I'd like to welcome you all once again. Since COVID last year, a lot of us, meeting rules and engagements have, been redefined. So you are not all new to the, should I say, housekeeping issues. Questions you may have, please feel free to drop them in the chat box. It will be collated on our side at the SEC, and we'll pass and read them out after each technical session or presentation of a paper. So my name is Temidayo Joseph Obison. Joseph, even in Egyptian Arabic and Arabic is Yusuf. And I know you know that Joseph is quite popular for dreaming. So I've been dreaming a lot. I dreamt this day will come to reality. It has. And I've dreamt as well that the pension industry will be investing more in non-interest capital market product. And that is a dream we plan to achieve. You're welcome and thank you very much once again. For all of you that are joining us, other parts within the markets system, complementary agencies, I like to call them, you're very much welcome. I'd like to acknowledge, before we just kickstart, Mr. Lamido Yuguda, the DG of SEC, and who will be speaking to us. Right after that, we'll be taking a goodwill message from Dr. Bello Danbata, that's the Secretary General of IFSB. And after that, a goodwill message from the Director General of PENCOM, herself ably represented, Ms. Aisha Dahi Umar. Then we'll now go into the paper presentations, which will form the key technical sessions. So on that note, ladies and gentlemen, I'm sure you are very, very accustomed to different webinars where the anchor person starts off with a joke just to make you relax. There will be no such jokes because this serious matter we're about to discuss today. And in order to make best use of executive time, I bid you welcome. Thank you once again. On that note, ladies and gentlemen, so we can start on the nick of time, it's 9:40. I would like to call on Mr. Lamido Yuguda, the Director General of SEC. I know it will be just for the other market participants that will be joining us. Every other person from in the capital market or the pension industry, I know he needs no introduction, but I'd just like to read out his profile, very short one, just to give introduction and background. He is the DG of SEC and has over 3 decades of experience in central banking, accounting, finance, economics, and investment management. He spent 32 years at the CBN in various roles, including leading for 16 years, a team that successfully managed reserve assets that grew to tens of billions of US dollars. In 1997, he joined the IMF in Washington on a 4-year stint. Well, I won't call 4 years a stint, actually. As an economist in the Africa department, he served in several departments of the CBN and retired in 2016 as the Director of Reserve Management. He has attended various leadership training programs, Harvard, INSEAD, IMD, Oxford, Wharton. Just populate the list of A-rated schools. He has been there, and is no other than Mr. Lamido Yuguda, the Director General of SEC. Over to you, DG, for your keynote address.
Thank you very much, Dayo, for that very warm, probably over-bloated introduction, but nonetheless. The Executive Secretary of the International Islamic Financial Services Board, Dr. Bello Danbata, the Director General of the Pension Commission, National Pension Commission, ably represented by Dr. Farouk Aminu, the Commissioner in General Administration, distinguished colleagues in the capital market, ladies and gentlemen, it is my pleasure to welcome you all to this virtual gathering on the imperative of non-interest capital market products for the pension industry. I consider this theme timely and relevant in the discourse of issues pertinent to the growth and advancement of the Nigerian capital market and the economy as a whole. I have observed with delight the attention that this seminar has generated and came to the conclusion that it is a clear indication of the keen interest on the potentials which the non-interest finance segment holds in furthering the development of the capital market and the growth of our economy. This event, hosted by the Securities and Exchange Commission, is the first in a series, and it is aimed at providing a conducive platform for knowledge and experience sharing among participants and to enlighten them on this alternative way of investing and financing. The pension industry is one of the fastest growing sectors in the nation's economy, with assets under management of 13 trillion as at the end of September 2021. Of this impressive amount, less than 80 billion is invested in Sukuk, representing a little less than 1% of total pension assets under management. This calls for more innovative financial products to deepen our market and sustain the growth in the industry, especially in the non-interest segment. We strongly believe that the capital market has a leading role to play in this regard by providing a variety of long-term investable products to service the needs of the pension industry, as well as other investors with similar focus. It is encouraging that the National Pension Commission has taken concrete steps to improve the regulatory framework for the investment of pension funds in the non-interest capital market by the introduction of the operational framework for Fund 6, which is the non-interest fund. This will no doubt provide an additional opportunity for retirement savings account holders and retirees to invest their savings in financial instruments that align with their ethical life goals and objectives. Indeed, the operationalization of the Fund 6 will definitely accelerate the national financial inclusion agenda while increasing the quantum of investable funds by unlocking the untapped capital in the economy. As at September 2021, the total assets stood at 7.79 billion, constituting a little less than 0.05%. I take that again, constituting about 0.059% of total pension assets under management. We are hopeful that the fund assets will grow with robust public awareness, education programs, and capacity building of stakeholders through tailored courses, seminars, workshops, and programs such as this. The SEC, in realization of the potential of the non-interest segment of the capital market as a veritable avenue for providing long-term capital, launched its 10-year capital market master plan with a very strong focus on the development of the non-interest capital market segment through awareness creation, capacity building, review of enabling regulatory framework, and development of non-interest products and services. I am happy to report that a significant number of its strategic initiatives have been achieved, as several Sharia/ethical funds have been registered by the SEC. In addition, the SEC collaborated with the DMO, Debt Management Office, towards providing a framework for the issuance of the first FGN Sukuk in 2017, and 2 other issuances of Sukuks have followed. However, we believe that more work still needs to be directed towards achieving other critical initiatives of the non-interest capital market plan. We, at the SEC here, we have actually been approached by quite a number of corporate issuers, potential corporate issuers of Sukuk. We have already registered the first corporate issue of Sukuk, And we are aware that a number of corporate issuers are actually interested in issuing sukuk, but some of them have noted that they would like, clarity on the tax neutrality of sukuks vis-a-vis corporate bonds. So we are working with the Federal Inland Revenue Service and the Federal Ministry of Finance to make sure that the guidelines on tax neutrality for sukuks are actually issued before the end of this year. The increased supply of sukuk will actually hasten the development of the non-interest capital market, because this product has been adjudged as one of the most appropriate for the funding of long-term capital, of long-term infrastructure, projects. So I'm confident, therefore, that the non-interest finance experts gathered here today will evoke the interest and attention of participants and enhance their knowledge on the subject to eventually lead to the birth of promoters and off-takers of new non-interest products in the capital market. Once again, I welcome you all to this event and wish you fruitful and interactive deliberations. Thank you.
Thank you very much, Mr. Lamido Yuguda, DG of the SEC. Quite a couple of important points you made, which underscores the importance of this webinar and expected outcomes. 13 trillion in assets and only 80 billion in sukuk or non-interest related capital market instruments leaves a big room and redefines a lot that needs to be done in terms of product creation and fostering engagement such as this to increase understanding and to foster participation by the pension industry, who for two main reasons, because I've been an asset manager, well, I was an asset manager in the capital market for like 16 years before I joined the SEC. They not only are they the first to be reckoned with because they've got the deepest bucket in terms of investable pool of funds, but for the technical knowledge they possess in sifting and separating the chaff from the grain when making informed investment decisions. On that note, we thank you very much, Mr. Lamido Yuguda. Without much ado, I'd like to call on, we're doing right on time, we're climbed to over 200 participants. Like I said, we are expecting to eat about 500 or more, and I'm sure people are still joining in as we progress. I'd like to call on Dr. Bello Danbata, who is the Secretary General of the IFSB. Dr. Danbata, previously the Director of the Center of Consultancy and Executive Program at INCEIF, has over 29 years combined experience in private academia as well as in the financial services regulation and supervision sectors across Africa, Europe, Asia, and the Middle East. He's a member of the Accounting and Auditing Board of Accounting and Auditing Organization for Islamic Financial Institutions, that's IOFI, the Basel Consultative Group, BCG, the International Ethics Standards Board for Accountants, that's IESBA, the International Accounting Auditing and Assurance Standards Board, and has chaired various working groups for the issuance of financial accounting standards for Islamic financial institutions. He has also been involved in the development and drafting of standards, guidelines, and framework for capital adequacy accounting, as well as in supervision and regulation of Islamic finance for various countries. And just to remove any doubts about the DR before his name, he's not a medical doctor. Dr. Danbata holds a PhD in Islamic banking and finance from the International Islamic University in Malaysia and an MBA in corporate finance. He's also a chartered accountant fellow of ACCA UK, a licensed international financial analyst, and a member of the Chartered Institute of Islamic Finance Professionals. He's a member of the NIM, ICANN, International Council for Islamic Finance Educators, and is very vast and deep in knowledge in this space. In addition to these corporate engagements, he has also held position as the assistant professor at the Sultan Qaboos University in Oman, a research fellow at the Accounting Research Institute of the University of Technology, MARA, Malaysian Academic Fellow at Insania University in Malaysia. He has also worked with the Highland Bank of Nigeria PLC, Peugeot Automobile, and most importantly, the Securities and Exchange Commission. So we'll make welcome for one of our very own, Dr. Bello Danbata, who has been quite supportive of Nigeria's journey towards familiarization and adoption of more non-interest capital market products. Dr. Bello Danbata, over to you. Thank you for joining us.
Thank you. Thank you very much, Temidayo, for such lengthy description. I hope I met all these things that you mentioned. I hope that may Allah subhanahu wa ta'ala bless it. Thank you very much. First of all, I would like to start by saying Bismillahir Rahmanir Rahim, a very good morning to all of you. And my sincere appreciation and gratitude to Director General of the Securities and Exchange Commission Nigeria, Mr. Lamido Yuguda. It is a great pleasure always to meet you and to see you. And I would like to acknowledge the presence on her behalf, Mrs. Aisha, who is ably represented by Dr. Umar Farouk. My friends, Dr. Bashir Ali Umar, my sheikh and friend, as well as friend Hajara Dioula and my ex-colleagues in the Securities and Exchange Commission. Wassalamu alaikum wa rahmatullahi ta'ala wa barakatuh, and a very good morning to all of you. It is indeed a great pleasure and honor for me to be part of this important discussion. This webinar is very timely. I believe the DG has highlighted a lot of developments that has taken place, and it demonstrated the commitment of the Securities and Exchange Commission and that of the PENCOM and the Nigerian Stock Exchange in developing the Islamic or non-interest capital market. Now, perhaps mine is just a goodwill message, and my goodwill message will also be very useful if I can give the participants some global bigger picture of the Islamic capital market or the non-interest capital market and how their products can be of great value in driving the aspirations as well as in developing the robust and sound Islamic capital market or non-interest capital market in Nigeria. I think Islamic finance as of today is no longer a niche, it's no longer an alternative, but it's a complementary system. There is no system that will be able to develop without having a robust financial system. And that robust financial system means integration of alternative or as we call it, complementary financial system, which is basically non-interest finance. I have some slides that I have shared with the team, so I don't know whether they can project or I can be able to maybe project it and share it by myself.
It's being put up at the moment.
All right. So perhaps while this slides is coming up, it's important for me to highlight what's the IFSB, because some of you are, we know each other and you are just hearing possibly IFSB for the first time. The Islamic Financial Services Board is an international standard setting body that was established way back in 2002, and we commenced operation in 2003. And it was founded by a committee of central banks and Islamic Development Bank. The central bank, 9 countries came together in 2002 to establish the IFSB with a head office in Malaysia. The IFSB started with 9 members in 2002, and today we have 187 members from 57 countries. And these members comprise us of 79 regulatory and supervisory authorities, mainly central banks, Securities and Exchange Commission, Financial Services Authority. And we have 99 market players. That means Islamic banks, Islamic funds, asset management companies, and other Islamic financial institutions. We also have in the membership of the IFSB 11 international or multilateral organizations, basically the Islamic Development Bank, and then the IMF, International Monetary Fund, the World Bank, the United Nations Development Program, as well as the Asian Development Bank. And of course, in Nigeria, we have the Central Bank of Nigeria, we have the National Insurance Commission, we have NDIC and SEC and JAIZ and Lotus Capital as all members of the IFSB. The IFSB membership has cut across, as I mentioned, in 57 countries, and we believe these countries that the IFSB have a membership will be are coming from different background, and this is what I wanted just to perhaps share. Maybe perhaps if you can permit me, I can just share the screen. Is it now visible? Myself?
Yes, it is. The screen is very visible.
All right, great. So the IFSB complements the work of, I can say, the Basel Committee on Banking Supervision, that is the BCBS, that is currently I'm sitting as one of the committee members for the Basel Consultative Group. We also have the ISCO. We complement the work of the ISCO by looking at the standards, guidance note, and guiding principles issued by ISCO. And we also complement the work of International Association of Insurance Supervisors as well. Because the work of the IFSB look at just the three sectors: Islamic banking, Islamic capital market, and takaful sectors. We do produce standards, we develop standards, and we facilitate the implementation of these standards. We do produce quality global industry research. We provide guidance on effective supervision and regulation by supporting with our members with some guidance notes and guidance principles. We also establish a database on the global Islamic financial services industry that we use to do some forecasting and do some research and activities for the purpose of advancing the stability and resilience of the global Islamic financial service industry. So in a nutshell, the work of the IFSB is actually to ensure that the global Islamic financial service industry is not at a disadvantage. Now, that work has contributed and support the development and growth of the global Islamic financial services industry asset. You can see as of 2018, we have 2.19 trillion US dollar in terms of asset. This comprises of the banking, as well as the Islamic capital market, the takaful, which is insurance, Islamic insurance, as well as the Islamic funds management assets. This has increased year-on-year growth by 6.9% in 2020, in 2019, and then 11.4% by Q3 of 2020, making a total outstanding assets under management for the global Islamic financial service industry to be 2.7 trillion in US dollars. The breakdown, I highlighted the breakdown for you to see the Sukuk as well as the Islamic funds assets. I think this is of great interest to the audience, particularly to see how this is being developed. You can see the categorization. While the GCC carried the junk, but as well we look at the Africa region that is coming up. A lot of development has been happening, and you will see that also in Europe, this constitutes the others, a lot of development in terms of the growth in terms of the total assets. Now, before I maybe perhaps dwell into a little bit more details on the Islamic or non-interest capital market, the Islamic banking share has been part of the financial system of many jurisdictions, and it has reached a systemic significance in many jurisdictions, even among the Muslim minority countries. You can see the market share of non-interest banking in Kenya and Sri Lanka, which are Muslim minority countries, actually superseded quite a number of even Muslim majority countries today. Why is that so? It's because of the economic value proposition of non-interest finance. I think that's what we always try to ensure that our members promote. We don't actually encourage anyone promoting ethical finance or Islamic finance from the Islamic religious perspective, because it goes beyond that. It's more on the economic value addition proposition that the Islamic finance have, and that's why we encourage arguments on Islamic finance or non-interest finance to be more on the economic value propositions. Quite a number of countries like Luxembourg, the Financial Service Authority of Germany as well, they are making tremendous development in terms of the growth of total asset. Now, considering the time, perhaps for the capital market, you can see the upward trend, the growth of the Islamic capital market or non-interest capital market in terms of the scope issuance. Recently, in the last week concluded even IMF and World Bank events, a lot of discussion has taken place on the advantages of non-interest finance, particularly Islamic capital market instruments or products like Sukuk that has over the conventional bonds. It was argued that in the World Bank, one of the World Bank session, that the issuance of Sukuk is by 0.05 basis points more cheaper than issuing of a conventional bond, even though the volume of structures, the requirement, the documentation is more voluminous in terms of issuance of the capital market instrument, particularly Sukuk. And then perhaps, of course, the countries that we always now try to look at their development in terms of infrastructure and advancements in terms of their economies is basically they are heavily reliant more on non-interest capital market. And I believe the decision by Nigeria to be part of, which has been well highlighted by the DG regarding the increasing potential increase in issuance of the scope is a great welcome development, and that has put Nigeria on the world map in terms of issuance of Sukuk. And Sukuk is actually needed now more than ever. We have seen quite a number of development and progress in many countries where they issue the non-interest capital market products in managing their economic developments. And Sukuk has proven to be very, very efficient, or capital market instrument or product has proven to be very, very efficient instrument in terms of the development of the economies. Of course, in many jurisdictions, sovereign issuances are more than the corporate issuances because of credit rating issues, and then the structures as well as the project that are being used to finance. But of course, multilateral issuances has also been increasing, like those that has been issued by the Islamic Development Bank. Now, for Islamic funds, I think maybe to give you a global bigger picture on where it is now, you can see year-on-year trend for the growth in terms of the asset under management and the number of funds from 2008 to 2020 has been very, very tremendous. And the growth has been very, very rapid. Asset under management has been increasing. And then number of funds has also, there is a slight decrease in number of funds because of the consolidation of certain jurisdictions, and then the merger of certain funds based on initiatives of economic reforms that has been taken by quite a number of IFSB member jurisdictions. But of course, in terms of the Islamic funds under asset management, are heavily domiciled in Malaysia, Saudi Arabia, Iran. And of course, South Africa, you can see also is quite substantial, even though it's just 1.2% of the market share in terms of the Islamic funds under asset management. Of course, looking at the 10-year historical performance of those funds has been on upward trends, and that gives some kind of comfort and future potentials for Islamic funds to be able to manage the pension industry, the pension funds in Nigeria. So I believe this is to say that we view and we commend the efforts of the Securities and Exchange Commission and that of PENCOM, the Nigerian Stock Exchange, in embracing this kind of initiative to have this kind of discussion and development in terms of the industry. Of course, the imperatives of any credible pension system depends on the adequacy in terms of benefits, system design, savings of the economy of citizens, and of course, government support and home ownership and growth of assets. Of course, integrity play a bigger role as well. Sound regulation is needed. Sound governance framework is also essential for any pension system to have a credible rating and even recognition globally. And of course, sustainability as well in terms of the coverage, the total assets, the demographic configurations of the pension assets as well, and the management, efficient management of public expenditures. These three basic variables is what the global pension index always used to rate countries, in which you will see if you have seen the global index for 2021, you will see the countries like Netherlands at the top, and then you see the countries like maybe Malaysia and other countries also doing very well, having a very good index. But I think the challenge that we have is actually how we integrate all these key variables into our own regulatory framework and supervision framework to ensure that the pension system is really credible, that you to be able to drive happy retirements and sound financial markets. And this will also be dependent heavily on the diversity and performance of the assets in terms of the way the assets are being managed, and this is something that we find very essential. And I feel that what has been taken on board by the Securities and Exchange Commission Nigeria, as well as PENCOM and all stakeholders in Nigeria, has been very, very commendable. But of course, I would like to echo the points of the DG with regard to the share of Sukuk in terms of the diversification of the pension portfolio in Nigeria is just about 0.69%. This is based on the PENCOM's report as of 31st March 2021. It shows that the Sukuk has been, in fact, is a little bit lower than 2020. And this was basically due to the payment of, some payment being made, and that's actually which was in form of arrears, that we feel that this is something that although it is needed, but considering the reduction in terms of the total asset by 12.5 billion naira due to depreciation in stock is something that's as reported in the PENCOM report 2021 as of 31st March, indicates that there is a need for more diversification. We want to have the stakeholders to please consider issuance of more Sukuk, and then to be able to have give opportunity for the pension industry in Nigeria to be able to diversify more into the non-interest capital market products. The inherent nature and features of the and safeguards for the non-interest, which is basically Islamic finance, give it a greater opportunity in the sense that Sharia compliance and non-diversion of funds are key features of the non-interest product, and we believe that this is what will be used and should be used to promote the developments of the pension industry in Nigeria. Inclusiveness and diversity is always a concern. We have the UK losing about 14.8 billion pounds annually in terms of contribution due to the fact that the Muslim minority in the UK are refraining from investing or putting their contributions into the interest-based funds. So, and I believe this is basically, of course, the level of awareness in Nigeria is needed to be enhanced, but I think this is also an area that will also be a part of the policy consideration when SC, that is SEC or PENCOM, is making decision to make sure that this is also being managed. Flexibility of returns and performance over time. This is a unique feature for the non-interest capital market products, which we believe that is also a justification for having this session today. And I believe this is part of the sensitivity, or the sensitization as well as the public awareness event that is being organized by the SEC. The integrated financial system, any economy now that wants to have an integrated financial system cannot left out non-interest capital market instrument and products. So, and then finally, it is a commendable initiative, and this is my summary of my goodwill message to this webinar. Digitalization, global pension index, as well as integrated non-interest capital market products, part of the global benchmark race that is happening in every economy, not only in Nigeria. So we will appreciate that the audience will take it positively and research more and try to have an expansion in terms of the non-interest products, not only for the funds, but as well as in terms of the way that the pension is being managed. We need to benchmark it with the global pension index, so that we will have Nigeria among the top countries that will be rated among the C class or B class in terms of the pension management. Of course, at the IFSB, we recognize the PENCOM's guidelines that pave way to having Fund 6, as mentioned by the DG. This is a very commendable initiative, and we believe this is what has driven the function assets and the portfolio diversification in Nigeria, and it is a great milestone. Of course, that could have not been possible without the initiative by the Securities and Exchange Commission Nigeria, who had before then, the non-interest capital market master plan, and has committed itself to the implementation of such master plan by coming up with a robust regulatory framework and committed leadership, as we have seen now by the current top management and leadership of the Securities and Exchange Commission in terms of the driving of the non-interest and the integration of, and as well as development of the capital market in Nigeria, because the capital market cannot be considered developed if it does not integrate non-interest finance. This is just the reality, and this is just the future. And I think this is, we in African continent, we need it more than any other continent when it comes to infrastructure development and financial asset management. So I sincerely commend the efforts of the Securities and Exchange Commission, and that's why we have the collaboration, particularly the team that are responsible for the non-interest capital market at the SEC. Their passion, their commitment to ensure they support the management in executing and implementation of the master plan, the capital market master plan, was very, very commendable. Of course, I'll not left out the efforts of the PENCOM and that of the NEC for coming up with the 40 index, that is Islamic Equity Index initiatives by the Nigerian Stock Exchange, was also very commendable. So on that note, I would like to once again thank the Securities and Exchange Commission for organizing this timely and wonderful events in form of a webinar with great participation. And we thank the DG, the Commissioner, for their own efforts in promoting and developing the sustainable finance for Nigeria, because sustainable finance is not complete without integrated finance, and integrated finance is only possible where you have the non-interest and interest-based finance. So with that, on that note, I once again thank you, and I wish you all the best for this very, very wonderful event. Thank you very much.
Thank you very much, Dr. Danbata. It's always a delight listening to you. You're truly an embodiment of knowledge in this space, and we thank you for always honoring us and for the strong partnership we've been enjoying with the IFSB, and which has culminated to recording some of the key milestones. I'm particularly pleased that Nigeria has put itself on the world map in terms of sukuk issuance, and we recognize that the potentials for increasing this 0.5% to 5% or probably 10% is very strong, which is one of the reasons where we are engaging deeply, especially with key stakeholders, cornerstone of which is PENCOM. And I particularly agree with you on Islamic finance being beyond just religion, just ethics, is more economic. It's strongly so. I've had the opportunity of listening to one of the foremost professors from the UK, and which underscores your points that UK strongly taps into the opportunities and the terms of distinct features of non-interest products in developing its own infrastructure and its own economy. Well, we are on the path to doing more, and knowing fully well that Africa has only 1.7% in terms of market share, in terms of global financial access. Probably by the end of this, and by the time we get the full attention of our pension fund managers, we'll push. Nigeria really want to lead the way to push that to probably 7.1 instead of 1.7. On that note, Dr. Danbata, once again, it's always a pleasure listening to you. I do thank you. We'll move on quickly to receive the goodwill message from Mrs. Aisha Dahir Umar, the DG of PENCOM, who is ably represented by Dr. Farouk Umar. I don't need to, well, I've taken the cue from DG and from Dr. Danbata, that instead of having lengthy introduction, anybody that doesn't know Mrs. Aisha Dahir Umar, and in this space, especially in pension and the fund management and the capital market industry, definitely go to the website. I mean, it costs a lot, and I'm sure the registration folks of SEC are here, because if you don't know the person that regulates PENCOM, that controls about 13 trillion in assets, who has led the way in paving way for creating, investing and promoting depth in the capital market through their investment, which we seek to do more, then we'll have to leave it at that. On that note, I've asked for my colleagues to put up the introduction or the short should I say profile, I won't call it short, of Dr. Umar online on our screen, just as I welcome Dr. Farouk Umar to deliver the Goodwill Message on behalf of Mrs. Aisha Dahir Umar of DG Pencom. Welcome, Dr. Farouk.
Thank you very much. Good morning, everyone. I would like to expand on the extensive and broad protocol established by the DG Pencom and the Secretary General of IFSP. So on that note, I begin the Goodwill Message by the DG Pencom, who, as explained by DG Sec earlier, has been summoned impromptu by the Senate Committee whose oversight function on National Pension Commission to go for budget defense this morning. So she is currently there taking the heat from the Senate. I wish her all the best. So her Goodwill Message goes off on behalf of the board, management, and staff of the National Pension Commission. I would like to express my sincere appreciation to the Securities and Exchange Commission for organizing this webinar on non-interest capital market products for the Nigerian pension industry. This is an indication of the recognition of the important role pension funds play as institutional investors in the Nigerian capital market. I would like to acknowledge with appreciation the collaborative efforts between PENCOM and SEC, which had over the years led to the entrenching acceptable values and good governance standards in the investment of pension fund assets in the Nigerian capital market. As you may be aware, PENCOM had on 22nd July 2021 released the operational guidelines on non-interest Fund 6 to guide PFAs in the management of investment of Fund 6 pension assets as provided in Section 7.3 of the Regulation on Investment of Pension Fund Assets. It is our belief that this singular act would promote financial inclusion in Nigeria. Particularly, it would drive enrollment on the macro pension plan. This webinar is therefore coming at an opportune time for PENCOM, as the dearth of investable instruments that meets the requirements of Fund 6 had been the major constraint identified in the implementation of the fund. It is my hope that industry practitioners gathered here will come up with practical measures to facilitate the issuance of non-interest investment in the market, of the non-interest instruments in the market. At this juncture, please permit me to draw the attention of participants to Section 3, 4, and 5 of the Regulation on Investment of Pension Fund Assets that specifies the authorized markets, allowable instruments, and minimum quality requirements for investment instruments to attract pension fund investments. PENCOM remains resolute at ensuring that all instruments meet these enshrined requirements before pension funds could invest in them. Indeed, the safety of pension assets remains a key objective of pension fund investment and our topmost priority. The theme of today's webinar has set open another golden opportunity for collaboration between PENCOM and SEC towards deepening the capital market to sustainably introduce non-interest products. It is expected that pension funds will seize this opportunity to meet the aspirations of the RSA holders who choose to have their pension contributions managed under Fund 6. As participants and stakeholders prepare for high-level discussions on investment of pension funds in non-interest capital market products under the theme imperative of non-interest capital market products for the Nigerian pension industry, PENCOM recognizes the importance of stakeholder consultation, which provides space for all participants to give back, make comments, and provide inputs that will address the challenges of investment of non-interest capital market products. Accordingly, PENCOM is looking forward to the various recommendations that will emanate from this webinar. It is on this note that I would like to once again congratulate SEC for organizing this webinar and express my gratitude to the management of SEC for their support and cooperation thus far, while hoping that the objectives of the webinar will be achieved. Thank you.
Thank you very much for wonderfully delivering the Goodwill Message on behalf of DG PENCOM, Dr. Umar. We do thank you. Ladies and gentlemen, the first part of our webinar is what we just concluded, taking the keynote address from the DG of the SEC, and Goodwill Messages from able and well more than competent authorities in this field, Dr. Danbata and Ms. Aisha Dahil Umar. Now we'll be going into the more technical part of the webinar where we're having papers presented. We have a total of 5 papers that will be presented. And in the best interest and use of our time, I'd like to remind all participants that as we go along, please feel free to use the chat box to drop your messages. We've been having some comments coming in, thanking and showing, expressing appreciation to all that have spoken, Mr. Lamido Yuguda, Dr. Bello Danbata, and Mrs. Aisha Dai Umar's Goodwill Message delivered by Dr. Umar. What we will do is, as we continue, all your questions, we'll take them as much as time can permit. After each paper, we'll ask that you please make them direct. If they are comments as opposed to questions, please indicate so they can be properly addressed. On that note, ladies and gentlemen, we'll move on to the first paper, which will be presented by Mr. Abdulkadir Abbas, who is the head of registration, exchanges, and market infrastructure and innovation at the Securities and Exchange Commission of Nigeria. As I've said before, we'll just, in order to make for more time, the profiles will be put on the screen as we go along intermittently, so we can save a bit more time for channel that with more questions and answers, so we can make this as interactive as possible. Mr. Abdulkadir Abbas, over to you.
Thank you very much, sir. Let me please write on the existing protocol that has already been established by my DG. Ladies and gentlemen, good morning. And our colleague, or our former colleague, Dr. Bello, very good afternoon to you. It's quite a pleasure for me to be part of this discourse. And I'm going to present a paper on the regulatory imperatives. Please, okay. I think, please allow me to share my screen. Okay. Please, can you see my screen, please?
Yes, confirm that.
Okay, thank you, sir. Okay, great. Great. So I think my DG and Dr. Bello have actually done the great work for me. I'm going to present a paper on regulatory initiatives for the development of non-interest capital market in Nigeria. And I have some outline, very few outline, which I think I don't want to spend much time on. Dr. Bello has actually captured part of what is on the recent trend in terms of the global Islamic financial service industry. So I don't want to really spend much time on that, but just to try to emphasize about the areas of concentration of Islamic financial assets, and looking at Africa as 1.7% compared to the other regions of the world or other part of the globe. But one good interesting aspect is actually that strike me is actually on the development of the non-interest capital market sector, which actually grew by 26.9% year on year, and has 30.9% share of Islamic financial service industry's total asset. If you compare to the Islamic banking, look at the growth at least. So really, that really one aspect that strike me. Now, Dr. Bello again has touched on this aspect, which is really giving a kind of global perspective with respect to where we are in terms of the issuances. Scoop is really one of the critical instruments that you can issue under Islamic capital market. And Scoop, you can look at the trend in terms of sovereign issuances and then the corporate issuance. And I think we have even good tracking as well here in Nigeria. Now, how did we start this journey? And I'm going to give our own perspective from the SEC. Actually, the journey actually started from 2004. That was when the SEC joined ISCO committee on how to define this sector of the market. I call it, in some jurisdictions they call it alternative finance, some non-interest or Islamic or ethical investment, as it were. And the ISCO actually was very clear in that committee, focusing on 3 critical pillars: regulation, stakeholders engagement, and eventually trying to see how we can really have products along that basis. That is really the focal point of that committee of ISCO, which Nigeria actively participated. And how did you, then from there, we can be able to see very good traction in terms of coming up with clear regulation, clear framework for regulating these products, because that is really the principal plan. You cannot be able to define any market without a clear framework which the market will thrive on. So it will be interesting, ladies and gentlemen, to state, in 2013, the SEC actually came up with a rule on issuance of sukuk. And this is in addition to the rule that we had on Islamic fund management, which we actually issued in 2010. And that is how we now had the Lotus Halal Fund, the Islamic IBT's Iman Fund. But really, in 2013, this rule that we actually issued gave birth to the first issuance of subnational sukuk, which was issued by Ocean State. And very interesting, story that I can say here. That offer, even though FENCOM asset was not allowed to be invested as at that time, the offer was actually oversubscribed. And that is really give us a kind of indicator that there is really the need to develop this, infant market. And really, we can see, you look at the project, it was really geared towards critical infrastructure, construction of schools. It was an Ijara-based sukuk, and we follow all the rudiments, including going to the FRACE, which is the Financial Regulatory Council of Experts, to actually get it certified, in addition to internal certifiers that actually give their own certifications Sharia-wise. So that really gives us a kind of courage or encouragement in terms of how to really move this segment further. In 2014, the Lotus Halal Fund, Equity Fund, and ETF was actually launched. And it was actually approved by the SEC. Now, very interesting milestone in 2015. That was what the DG really touched about on the need to have a 10-year master plan, which was launched in 2015. And the whole idea is to really make the Nigerian market to be an investment destination when it comes to non-interest. And we are saying that by 2025, we are projecting to have at least 15% representation of total debt issuances being issued by sukuk. The journey is still ongoing. We are still having a good traction in that respect. But just to try to give the flavor, ladies and gentlemen, the master plan is built on at least 4 strategic objectives. One is to see that we build a very strong regulatory foundation, which is the starting point. If you don't have robust regulation, there's no way you can build a market. And we strongly believe in that. And we try to get a cue from or benchmark from just jurisdiction that actually advance in terms of developing their own framework, Malaysia in particular. So to be able to encourage the development of this, the market stakeholders, that will now lead to introduction of these products into our market. And then eventually, we really target to create a regional hub for Islamic capital market instruments, as in Nigeria. And that is really the aspiration of the 10-year master plan. Now, somebody will ask, okay, what are these initiatives that will lead you to achieve that? And we really come up with very great initiatives in terms of strengthening institutional capacity of the SEC as a regulator. That is how to start, really. Then strengthening this kind of coordination among the regulatory bodies. And this is really why we have this kind of interface between the PENCOM, the CBN, the NICOM, and even other regulatory bodies offshore. Then we have this kind of initiative to have really robust engagement. And we have been doing that as far as 2016. A kind of nationwide engagement really synthesize and enlighten the market about the opening in this sector, so that we can be able to really see more inroad in terms of defining that sector of the market. And then, of course, eventually, we're even trying to see how we can really enhance promoting cross-border issuances, cross-border issuance of sukuk, leveraging on our existing rules for cross-border issuance. So we have dual issuances, dual listings, and we have a kind of robust framework that will really enable that to happen. But first of all, to really see how we can domesticate the issuances in our own market. It is only when you domesticate it and people see traction, even foreign investors will be able to see traction in our own domestic issuances before you can think about really encouraging our offshore issuers to come into our field. Now, in terms of the master plan, These are the really key prime recommendations of the master plan. And I think I can be able to really give a story about where we are and what we have really achieved. In terms of the guideline, I think DG touched on that. PEMCOM, DG has touched on that as well as Dr. Bello. In terms of the guidelines for Fund 6, that one has already been released. And we were able to really get the guidelines on liquidity status be released by the central bank as well. In terms of issuance of Sharia governance, standard, we actually have a governance standard, but what now happens is that we are actually trying to fine-tune the standard to be in line with the best practice, leveraging on clear standard issued by IFSB. Now, in terms of provision of clarity on tax or tax neutrality, we have really made an error as well, because the framework has already been finalized, awaiting the minister's approval, as the DG highlighted. Talking about trying to define the market further in terms of short-term liquidity, Sharia liquidity instruments. This is really an ongoing conversation, and we have really reached a kind of level where we are having a discussion on how to come up with a concept note to be able to allow DMO, Debt Management Office, to see the possibility of issuing this kind of instrument. In terms of facilitating other instrument, their commodities, commodity muraba for instance. The Commission, through a commodity ecosystem, has actually come up with a kind of framework to enable this kind of issuances to take place. And we're in discussion with some commodity exchanges towards seeing the possibility of creating products that will really be Sharia compliant and will be Sharia commodity based. Commodity muraba is one of the products that we're looking at in that space. Now, looking at trying to see how we can really partner with other stakeholders towards investor education, awareness is actually an ongoing exercise. And we really have a standing committee and CMC committee that are really doing that great work. We can be able to say that we have really good traction. Only one issuance, subnational, but we are looking forward to see more of subnationals looking at issuing scope for critical infrastructure, because be it school, be it hospitals, be it any other social project that you can be able to do. And you can even have a kind of scope that will be tied to a project type scope, so that the revenue of that project will now be used to pay back the school holders, as the case may be. Now, trying to have a benchmark, similar to what we have for the sovereign issuance. We have been engaging the DMO to have a kind of calendar of issuances of this sovereign paper, so that you can really have a kind of benchmark. Now we have conventional sovereign up to 30 years, you can benchmark. And if an issuer, a corporate issuer wants to issue, he can be able to benchmark against the sovereign. So that is the idea of really trying to, this is really a kind of ongoing conversation to see that we have really a kind of calendar of issuances in terms of sovereign issuance of scope. Then introducing listing rules. This is really a done issue because we have really achieved that. The exchanges have a framework that we approved for listing of these securities, scope in particular, and then the ETFs and the index, which has already been on the platforms as well. So all the scope that the sovereign have issued are actually listed on the trading platform, which we have approved. So just in a nutshell, to just give the flavor in terms of issuances, we talk about the Lotus, fixed income fund, which was actually launched in 2016. 2017, the issuances by the sovereign, 2018, and one really that interests one is actually the issuance in 2020. And this really shows the potential in this market. An offer that is 464% oversubscribed, it will really give you the signal that there is really demand or serious demand for that kind of product. And that is really a signal that we really need to up our game in terms of fine-tuning the rules and encouraging more players to come into this field. We have to create two ends, both the demand and the supply side. And that is why I'm really happy to be part of this conversation, to really talk to the pension fund administration and other investors that there is really opportunity. And even the issuers should be able to brace off to really issue this kind of instrument, be it corporate. Corporate in particular is really an area that we need to really work to see that more issuances happen in that space. Now, very interesting story that I would state in terms of further issuances on non-interest REITs is actually the one that was issued by Chapel Hill. It was a 100 billion program, which we approved, and they were doing issuances, in tranches or in series, as the case may be. And this is really a kind of game changer towards really opening up the real estate segment of the market. So there was that issuance in 2020, and in 2021, we had this debond corporate scoop issue. It's an Ijara, scoop issued by family homes. And really that offer too was actually oversubscribed. Again, to show that really there is a demand, very good demand for that, for the instruments. Now, in terms of non-interest capital market governance initiative, what have we done really as SEC? And this is really a story that I think we have started having very good conversation with standard setters. But to start with, we have very good collaboration with Financial Regulatory Council of experts in terms of enhancing or trying to see how we can streamline this certification of these products. We have arrangement with the FRES. Whenever we have application for, let's say for scoop or any instrument, apart from the internal certifiers, Sharia certification, we have FRES that will now subject it to another level of recertification and giving a kind of confirmation that it is actually in line with the Sharia principle. And that is really very interesting. It will really strengthen the market, and it will give the comfort to even our PENCOM, the PENCOM as regulators, and even the FFAs that are going to invest in this instrument. And we have a provision for continuous certification throughout the maturity of that, up to the maturity of that product. Let's say it is a scoop, for instance. We have a requirement that it has to be recertified every year, annually, up to the end of, up to the tenure of that instrument. Now, and this is really in line with the ISCO principle that DG touched on, to actually protect investors, ensure market, fair and transparent and efficient market, and to actually reduce systemic risk. Then, in addition to that, we have been collaborating with AOFI, that is Accounting and Auditing Standard Organization of Islamic Financial Institutions, and that is really why we have we try to see how we can align our standard, accounting standard, with the best standard given by AOFI. One other interesting aspect is actually our collaboration with Islamic Financial Services Board, IFSB, and we really want to really thank Dr. Bello for that. And as at now, we try to even align our own governance initiative to all these standards that has been highlighted. IFSB 6, which is the guiding principle on governance of Islamic collective investment scheme. We actually try to align with what IFSB actually provided. And we're having a kind of workshop and seminars to really understand and see how we can fine-tune our rules to accommodate this standard. In terms of guiding principle on Sharia governance, which is very critical for Islamic financial institution and Islamic capital market product, we really try to take a cue from those standards as well to enhance what we have as existing framework. Talking about IFZ 19 is actually on disclosure, and this disclosure cut across whether it is scope or collective investment scheme, which we have actually incorporated and we have been implementing in all the issuances that we're approving. Now, IFZ 21 and 24 actually touch on the Islamic finance regulation of the entire capital market segment, and the investor protection as well, which is actually the principal plan for regulation. So we have really covered that space, and I think it's really a very interesting area that we have to actually deepen that market further. In terms of what we are doing, we're looking at other enablers. Fintech is really a fast-growing segment, and we can see that at least we have a committee that really look at the entire fintech ecosystem, and we try to see how we can really align some of those fintech initiatives. And the critical one is actually the digital ledger technology, whether you call it blockchain or whatever kind of technology that will really be able to really be used for Islamic financial products, especially scope and other instruments, even the collective investment scheme. It will really help in heightening transparency via the smart contract that we have, or even prevention of funds commingling. Because for Islamic funds, for instance, which is similar to conventional funds, you cannot be able to commingle the asset of the fund with that of the fund manager, for instance. Even in terms of liquidity management for banks and other fund managers, we can be able to really use the digital ledger technology to be able to have it will align to structure products that will be Sharia compliant in a very smart way or an easy way, and it will now really be conformed to what the central bank will adopt to really give the likes of Jaiz Bank or the Lotus Halal Fund, for instance, and other, or even Fund 6, to be able to really invest in this kind of short-term Sharia liquidity instrument. Efficiency in terms of real estate valuation can be done through the blockchain as well, or through any digital ledger technology, as it were. Now, and then even the lender for last resort, the Tawaru or Muraba kind of contract can be structured in such a way that you can be able to be doing it very easily, and you can be able to track this kind of issuances or products, and then the lender of last resort can be able to be comfortable, and also the Sharia advisors can ensure that it has actually complied with the laid down Sharia principle. So this is really a kind of way forward to see how we can really benefit, and we're really looking at it very closely to see which one we can be able to adopt to be able to really enhance more issuances. So in terms of even social financing, wealth management, capital raising exercise, capital market transaction, and other digital asset platform, we are looking at that to see how we can really define the market further. Now, we have really great opportunities in Nigeria, and I think everybody really appreciate that. I think the speakers, previous speakers, have really touched on that. We have a GDP of over $400 billion, for instance, and look at the vast population. And how do you really define the market further? By creating this kind of instrument that will really, catalyze into really defining the economy. Infrastructural deficit is really critical to us. And Scoop and other instruments are very, very good instruments to be adopted to really address this concern. I think we really have urgent need to see that we really, tap into this market, and both the issuers and the investors will really be comfortable. If it is well structured, we have well structured, guideline that we can be able to track and monitor the utilization of the proceeds, as it were. Now, the high demand of non-interest, as shown by the sovereign issuance, and even the corporate issuance, actually show a great potential in that segment. And coupled with the COVID, the pandemic has really opened a way of social responsible investment, and which non-interest or ethical investment actually provide. So, in conclusion, ladies and gentlemen, what are we really looking at as SEC? How do you really see how we can define this market further? We appreciate the fact that in our own context, the market is still at the infant stage, but really there are potential to improve or to develop it further. So we continue, embrace, and then develop, introduce regulation, enhance our regulation to further the market, continue to foster partnership, which is a great one. This partnership that we have with IFSB, which we continue to have, and even the new innovation that they introduced, train the trainers, initiative, which we are participating. I think is really a great idea to really see how we can define this market further. Now, digitization is really a kind of way forward, and this is really an enabler to support. We have rules on crowdfunding, and we can be able to mimic that crowdfunding regulation to facilitate, ethical or Islamic financing for SMEs and any other, investors. Now, developing a dynamic, fair and transparent and efficient market, and this is really the hope. This is really the ultimate in terms of really giving everybody comfort, including our, PFS that really are yearning to get products that are really bankable, and that is really that having comfort in terms of investing. So, ladies and gentlemen, I conclude my presentation, and I thank you very much for giving me this opportunity. Thank you.
Thank you very much, Doctor. Well, I was going to call you Doctor because I was so lost in your presentation. Thank you very much, Mr. Abbas, on regulatory initiatives for the development of NICM. I'm sure a lot of nuggets have been taken, and the level of works that has been done, has been carried out by the SEC in pushing and just ensuring that we actualize the plans already laid out in our capital market master plan. It was succinctly put together by you, and we thank you for that. I'd like to again, remind our participants that have joined us to keep using the Q&A or chat box just to drop your messages or questions. I think one of the things we'll do as the I think we're almost 330 people. We're about 330 people now, and I'm sure the numbers will keep rising. And I'm sure you all have questions, maybe like guides. Like I said, I've received some. Someone had already mentioned on the chat, I think that was Dr. Bello Danbata's chat on Islamic fund assets, which appears not to capture Nigeria, despite the halal funds that we have, and was wondering whether that was an omission or probably they are not recognized. Even pending, if we still have the opportunity of having Dr. Danbata's attention towards the end. I know the chart was put in terms of figures and comparatively. So it's a relative graph that was shown. So it is possible that Nigeria, because all the halal funds we have in terms of the dollar terms, which was the common denominator, may not have been significant enough to show up on the chart, probably less than 0.0001% in terms of the halal funds. But if we have the benefit of just having his own direct input so he can assertively say this, we'll just let him know, let you know. Also, I've gotten several comments of people quite applauding the presentations and the speeches that have been given earlier and asking for copies for their future reference. We'll look into that, and I'm sure the secretariats that put this together have already have, especially if you have registered your details, and we can look into sending that to you after now. On that note, once again, I thank you, Mr. Abdulkader Abbas. Without much ado, there's Mr. Abbas, but just before you go, there's one question I'd like to quickly put to you. Someone just asked one question that
Yes,
there are so many Islamic products, and it appears that Sukuk is the one that is being repeatedly pushed or being proposed or the most dominant in our market. I was wondering why we are not exploring others. I don't know whether you want to respond to that or we'll just wait till the end. Probably the same question can be answered by other presentations as we go along.
Sir, if you can just quickly allow me to very quickly just respond.
Please go ahead.
Thank you. I think my immediate response is that it's not only Scoop that we are pushing. Remember, we even started by coming up with the regulation on Islamic fund management in 2010, prior to the issuance of the rules on Scoop. As a matter of fact, we have quite a number of Islamic and ethical funds which we have registered, and they're doing very well. Apart from that, we have been promoting other instruments that I mentioned, the commodity muraba, talking about, in terms of commodity enhancing or deepening that commodity sector, So there are quite a number of things that we're doing. It's not only focusing on Scoop. Why we talk about Scoop more frequently is because if you look at in terms of how you can really link up financing infrastructure with Islamic financing, Scoop is one of the instruments that you can easily structure. But again, we have other instruments that, as I mentioned, we can provide that details later. Thank you.
Thank you. Thank you very much. Thank you very much. And thank you very much for that response. So on that note, we'll just go to the next paper presentation, which will be given by none other than Dr. Farouk Umar, the Commissioner Administration of the PENCOM. We saw his face earlier, and he'll be coming back to speak to us now. Like I said earlier, his profile has been put on the screen just for us, just to eyeball and just to again reassess and to reconfirm is the adequacy of his knowledge and leadership in this space, especially on the buy side, should I put it. So without much ado, Dr. Umar Farouk, if you please go ahead to present your paper on framework for non-interest pension fund operator and on the operationalization of Fund 6. You're welcome, Dr. Umar.
Okay, I have some slides which I would want, I've already shared them with the SEC team if they can just play them for me, please.
You may share them if they are readily available as well,
yes,
so you can control it.
The day before, so if they can, you can just slides for me.
All right.
Please.
So that will be put up shortly.
Okay. Okay, good. So we just go to the next two slides, please. The next one, please. So good. The presentation is supposed to, is going to be an implementation framework for the non-interest fund, that is Fund 6. And we'll start with the legal framework because that is the basis. As we are aware, in 2018, the Commission issued a new regulation on the investment of pension fund assets, which introduced the multi-fund structure. At that time, we limited ourselves to just 4 funds, funds 1 to 4, and later we introduced the macro pension fund, and finally, of recent, the Fund 6 was introduced. So this made the total number of funds under the pension industry today to 6 funds. And basically, Fund 6 is trying to address the concerns of the contributors for their pension contributions to be invested in halal investments. So provisions were made under sections 1.4 and 7.3 of the investment regulations for the introduction of Fund 6. And indeed, Section 85 of the Pension Reform Act 2014 made a lot of provisions on do's and don'ts, what is allowed, what is not allowed in terms of the instruments that pension funds should be invested. So all those provisions of the Act must also be adhered to ensure safety and fair returns on investment. Section 4 of the investment regulation required PFS to invest on 6 assets and instruments that are both ethical and non-interest bearing. So basically, the fund is an ethical fund on top of the fact that it is also supposed to be full of halal investment. We shall see some issues later that may allow the funds to go into some interest-bearing instruments. The contracts are going to be basically 2 under Fund 6 because we have active RSA contributors and then those who are already retirees. For the active contributors, the contract is going to be based on principles of Wakala bil Istismar, which is agency contracts. Basically, you invest and you take a bit of the total assets, the gross assets as your reward for what you are, for the services that you provide on these contributions. While for the retiree, it's going to be based on the principles of Mudaraba contracts, that is profit and loss sharing, partnerships, and basically that is what we do at the moment. For the active contributors, the regulation on fees allow asset-based fees to be charged. So you charge a percentage of the gross assets under management to defray the administration, the custody, and regulatory services that are provided by PENCOM, PFS, and the pension fund custodians. While for the retiree fund is basically just taking a percentage of the profit that has been generated. At that level, we don't want to subject the pension assets into some volatility, so are more restricted into more of sort of assured income through more of fixed income placements. So basically, you are taking only part of the income, not the real assets. And indeed, on 6 assets are totally prohibited from being placed under some speculative tendencies. So they should be free from all uncertainty. And so basically, they are assets that are free of any gar under the Islamic commercial jurisprudence. And then derivative products such as futures contracts, swaps, options, and forwards are considered as speculative and uncertain. So they are not allowed under, under Fund 6 arrangements. Next slide, please. Next slide, please. In terms of governance, the administration is going to be done by PFAs, basically, and then the custody of the assets is going to be provided by the pension fund custodians. This is what we have at the moment. The pension fund administrators just provide administrative services. They open accounts, they give you all account services, they direct what instruments should be bought, and so on. And then at the end of the day, they also administer the retirement benefits. While the pension fund custodians have the assets with them under their custody, and they implement whatever investment decisions are taken by the PFAs. And finally, when it is time to pay the retirement benefits, it is the PFCs that basically make the payment. The Commission remains the regulator and supervisor of all activities on Fund 6, as we do with all other pension assets under Funds 1 to 5, and indeed the approved existing scheme assets and the closed pension fund administrator assets. The FRES shall serve as an advisory body to the Commission on Islamic Finance Matters. This is a policy decision that whatever the press, whatever we are going to do, it has to be sanctioned by the press. And we are binded by the decision of FRES on all activities regarding Fund 6 transactions. So either the regulation has to be sanctioned by FRES, also whatever we would do on, regarding Fund 6 as a regulation, administration, and custody, it has to be sanctioned and approved by FRES. But on top of this, we realize that FRES is really very busy. They handle things for not only the financial sector regulators, but also for federal government and so many other commitments by the FRES. So on that, we are going to introduce a middle committee of resident Sharia advisors for the pension industry. Remember, we are consumers of any product that is going to be issued. We are not issuers, so we don't need sort of rigorous work under the pension industry. What has been approved by other residents Sharia advisors, provided it is approved, sanctioned by FRES, we are ready to go. But indeed, our own resident Sharia advisors will ensure continuous Sharia audit and purification of the investment pool of Fund 6 assets, including disposal of non-permissible income. We shall discuss about that later. In the first instance, the portfolio composition of Fund 6 shall be made up of Sharia-compliant instruments. Now, as mentioned earlier by DG Said, the total assets under Fund 6 today, just about 7.8 billion. And you can see that really we have enough compliant instruments that can accommodate this amount. But we envisage that in the future, probably near future, a lot of people will sign up to Fund 6. And when that is done, when we start to have Fund 6 assets reaching $1 trillion, 2-3 trillion, then perhaps the Nigerian financial market, which is available of Sharia compliant instruments, may not be enough to accommodate this money. So where such situation exists, then of course the PFAs are going to place all the assets in Sharia compliant assets. But if there are any gaps, then those gaps shall be filled up with conventional securities and instruments. And that's why our Sharia resident Sharia advisors would have to do a lot of work in purifying this income that will come from placements in these conventional securities or instruments. Now, PFAs must provide justification for all non-Sharia compliant securities in Fund 6 portfolio, because we're just envisaging, and it's a possibility when Fund 6 become too large, then definitely what is available in the market may not be able to accommodate. So when PFAs take decision to to fill up any gap with conventional securities, they must provide enough justification that would, allow them to do that. So it's going to be really done on the principle of darura. There must be a darura to do that before that is allowed. And that should be sanctioned by the resident Sharia advisors. And the commission, when this is done, should be reviewing a market situation and availability of products to determine the terminal date for conventional assets on Fund 6. So whatever placements done by the PFAs, the commission shall be doing is daily, routinely study of the market situation, and then looking at the availability of products such that PFS will be diversifying from the conventional assets into Sharia compliant assets. And when we are comfortable with the market situation, we'll determine a date that will be the final date when PFS will be required to go into any conventional securities. Next slide, please. Now, there are transfer modalities. If you want to transfer your fund from Fund 1, 2, 3, 4 to Fund 6, all that should be done in accordance with Section 7.5 of the investment regulation. There it is allowed that you can go into, if you are just beginning, you go into Fund 2, that is the default fund. However, on choice, you can go to Fund 1. Again, on choice, if you are starting work today, instead of going to Fund 2 or Fund 1, you can choose to go to Fund 6 straight by expressly directing your PFA to take all your pension contributions to Fund 6. Likewise, if you are in Fund 3, you can do that. If you're in Fund 4, you're already a retiree, you can also do that, it is allowed. So basically, all that applies to individual RSA holders in moving the contents of the RSS between funds within the same PFA or even across PFAs, that apply to Fund 6 as well. So which means somebody may decide that he is in Fund 6 and he wants to return back to, say, Fund 4 if he's a retiree, or to Fund 3 or 2, depending on his age. So it is allowed to do all this across movement based on the provisions of Section 7.5 of the investment regulations. So if you look at, as I mentioned, yes, it's allowed even those who are retirees to move to Fund 6, and if they want to go back to Fund 4, they can go back to Fund 4. That's if you are a retiree or any other RSA holder. At the beginning, the nominal unit price of Fund 6 shall be 1 naira. So it's the same. If you have, for example, units, say 1 million units in Fund 3, those 1 million units will have a naira value based on the value of the unit in that particular fund. Now, when you transfer to Fund 6, we're saying the total amount, if, for example, the unit value in Fund 3 by your PFA is 3 naira, that means if you are transferring 1 million units, you are going to transfer 3 million naira in value to Fund 6 because it is 3 naira per unit under the current Fund 3 or no, by your PFA. So you transfer 3 million. Yes, that means you are going to have 3 million units in Fund 6 that are valued 1 naira per unit. So basically, you are not going to have any advantage in terms of naira value, but basically you are transparent for accounting purposes and auditing. It's better we start on clean slate as we began with every other fund. So everybody is going to have his units revalued to just 1 naira, but the value is going to remain the same. So when that valuation is done, the naira value will just go to Fund 6 as the nominal price of 1 naira per unit. Thank you. Go to the next slide, please. Next slide, please. Now, in terms of auditing, accounting, and disclosure requirements, really, we have not reduced or made things difficult in terms of what is being done now by the by the PFAs in managing funds 1 to 5. However, because this is a non-interest fund, then we must comply with the relevant standards on disclosure issued by certain organizations, including the Financial Reporting Council of Nigeria, the Islamic Financial Services Board, and Accounting and Auditing Organization for Islamic Financial Institutions, AOFI. So we, on top of whatever the PFAs are doing now in reporting the assets under their management for funds 1 to 5, we expect that they also ensure that they meet the requirements or the provisions of IFSB and AOFI. And indeed, any corporate governance issues on funds 1 to 5, we expect that PFAs must also ensure those are adhered to strictly in terms of management of Fund 6 assets. So there are a lot of those code of conduct issues, code of corporate governance issues that have been issued by the Commission and the relevant authorities in Nigeria. Those must all be adhered to and complied with. And indeed, on a monthly basis, PFAs must provide reports on the percentage split between compliant and non-compliant investment. I discussed this earlier, so that the Commission will be able to understudy what they have done and why they have done it. And if we believe that there are some new products that have been issued in the market, we direct them to divest some of the non-conventional, the conventional assets into the more Sharia compliant assets that are available in the market. And whatever records they do have, they must maintain all those records to show all earnings, receipts, payments, and charges made to the Fund 6 and render regular reports to the Commission, because this will allow our Sharia committee to be able to advise us properly in terms of auditing and taking out the income from the conventional assets. That's those are, the income from non-Sharia compliant assets that PFAs had bought due to the rule that I mentioned earlier. Next slide, please. Next slide, please. So this is the these are the investment limits for the active bit of Fund 6. We allow all federal government instruments. So it can be Sukuk, it can be any Islamic Treasury notes or Sukuk if available, Euro Sukuk issued by federal government, or the Central Bank of Nigeria, or any other federal government agency, and infrastructure Sukuk backed by federal government or central bank guarantee. We are saying for all those federal government related instruments, the PFAs could go up to 70% of the total assets under management. For state and local governments, it's 15% if the issue is backed by an ISPO, or there is a guarantee and sweetener attached to that. Then 3% if the issue is not backed by an ISPO or any guarantee. I know that some scholars talked against these guarantees, but I'm happy that my senior brother, Dr. Bashir, is here. I can shed more light on this, and we're ready really to go with whatever positions the press might have on these issues of guarantees. For corporate Sukuk, which I'm happy the DG Sec mentioned earlier, it's bringing up. So we have made provision for that, and really we're saying PFAs could place up to 40% of the total assets under management. So this is really a very big opportunity for issuers to really do their due diligence and issue Sukuk that would actually meet the requirements as enshrined in the investment regulation. And indeed, infrastructure Sukuk as well. If it is infrastructure Sukuk, it's up to a maximum of 20% out of this 40%. So any corporate issuers, we could go up to 40%, or indeed, if there is any corporate that is issuing an infrastructure Sukuk, that could go up to 20% out of this 40. So if they're issuing 40, and then, they have some other instruments, and then they have infrastructure Sukuk, then the infrastructure Sukuk can take 20, and then the remaining 20 can go into other corporate Sukuk issuances. by the PFAs indeed, and then by the individual issuers, corporates. So for national scope issue, we can go up to 20%. These are scope issued by the World Bank, AFDB, IFC, and so on. And then any Sharia compliant money market instrument, including bankers' acceptances, commercial papers, or corporate entities, we allow PFS to place up to 30% of the total assets under management in those. Next slide, please. So for ordinary shares, we maintain 25%. So indeed, there are, so somebody just asked a question about talking about scoop squares. There are a lot of instruments that are Sharia compliant that are out there, already listed on the stock exchange. So those, equities that are listed on the stock exchange that meet all the requirements of the investment regulation and also meets the Sharia compliance requirements, PFS can place up to 25% of the total assets under management in those. And if there are some special Sharia compliant infrastructure funds, 5% would go into those. And any private equity funds that are Sharia compliant, we also made a provision for 5%. And if there are any, Sharia compliant mutual funds, open, close-end hybrid funds, including ETFs and rates, we can go up to 20%. We try to do as much as we can within the context of the development of the Nigerian financial system and what we feel is available outside the market, or what the market could easily issue, and then make these provisions. Perhaps I believe it will take some time before there will be any call for some revision. Next slide, please. So this is basically for the retiree fund. The basic difference is that for the federal government, not any papers by federal government were saying we'll go up to 80% here instead of 70. For state and local governments, we do 20 and 3. So basically not much change. For corporate scoop, we're doing 40 there. For the active, we're doing 45 here. And for infrastructure, we did 20 for the active contributors. So I'm saying for retirees, we do only 10% for infrastructure scoop. So for national scoop, we're saying do 20% here. And then any money market, we're saying do 35% for the retirees in Fund 6. Okay, next slide, please. Okay, for ordinary shares, because these are retirees and we don't want too much volatility in their assets, instead of doing 25%, we're saying do 5%. The issue with the retirees is that we always want their assets to be, placed in instruments that are a bit stable. We don't want an event to happen today and then somebody is taking pension tomorrow and then you dip your hands into the pension asset because you have to make up and pay the pension. You pay the pension, and indeed what you are doing, because there is too much hole now created by losses in the capital market, as today, or some couple of days period prior to the pension benefits being withdrawn, that gulf may not be closed quite quickly. And then you continue to eat up into the assets of that individual, and recovery may never happen. So for that reason, we're saying, well, keep it, keep the quoted equities in the retiree portfolio, but make it so small that it may not create too much problem for the retiree. We totally said for the Sharia compliance infrastructure funds and for the private equity funds, we are trying to be really very, very cautious with the retiree assets on saying, don't go into those for now until we study the situation and have a better understanding of all those before we allow. But indeed, for the mutual funds, are saying do 5%, including ETFs and rates. Next slide, please. So there will be fees charged indeed. And normally the fees that are charged are to cover regulatory services, administration services, and custody services. So PENCOM will have some charges as allowed by the law. PFAs and PFCs will also charge some amounts that have been also allowed by the law. For the active fund, PFA is going to have the 1.2% on the total assets. Remember, I told you it's going to be on Wakala bil Istismar. So it's going to be 1.2% of the assets. The PFC is going to have 0.25%, and National Pension Commission is going to have 0.2%, a total of 1.65%. And this is basically the same charges as we do on the existing Fund 2, because the Fund 2 and the Fund 6 have some similarities in terms of the portfolio composition, only that these are Sharia compliant, and this are, this may include conventional assets. For the retiree fund, it's going to be a flat charge, as I mentioned, on it's going to be on the principle of Mudaraba, that's the profits Allah sharing, and it's going to be a total of 7.5% of the profit. When a profit is earned, 5% of that profit, of that 7.5, goes to the PFA, 1.5% goes to the PFC, and 1% goes to National Pension Commission. Normally, the way these charges are done, they are computed on daily basis. So PFA submit reports to us on daily basis about their investment activities, and we mark to the values of the assets on daily basis and charge the daily valuation of the PFAs on. We charge these assets on. These values that I mentioned, these percentages on the daily value, and then we accrue these daily values and we knock them off at the end of the month. So it may be that the total value is, for example, 1 trillion. So we charge all these percentages on the 1 trillion today. Tomorrow it will go to 1.1 trillion, or it may drop to 950 billion. So we charge, based on this concept. So if it is high, of course, the charges will be higher based on the higher asset under management. If it is low, the charges will be lower in terms of value because of the losses. And indeed, if we look at the retiree, if there are losses, then there may not be any charge by the PFA, because there won't be any charge by the PFA or by PENCOM or by the PFC. So basically, this is to give you the implementation framework for the net interest fund, and hopefully my duty is not to really go into details about these things or the Islamicity of this. That has been done. We're happy by phrase, and I'm happy, as I said, we have Dr. Bashir here. If there are issues about that, he will help me tackle them. Thank you.
Thank you very much, Dr. Farouk. That was quite insightful. I'm sure in the interest of time, because we need to just stay on the time plan so we don't get into the fatigue of just sitting down for too long and listening to all the interesting papers that have been presented. I'll just again encourage all participants to take advantage of the chat box and the Q&A platform to drop in your messages, and your questions. And what we will do is we'll take 1 or 2 more papers, collate all the questions. We can send them directly to the presenters, who will have gotten their responses ready. So we'll have it directly put once we call on the questions. So please hang on. So in the interest of time, that's the way I think we should best coordinate it. Thank you very much. On that note, I'd like to welcome Dr. Bashir Umar Aliyu, who is the Vice Chairman of the phrase, to deliver his paper on value proposition of Sharia contracts. I have requested that Dr. Aliyu's profile be shared on the screen as it currently is showing. I think one of the key things to even look at is the third paragraph. That is the chairman of the board of trustees of Al Furqan Charitable Foundation, and that has under it a number of schools, mosques, and Islamic centers. He is also a member of the board of trustees of the International Center for Islamic Culture and Education. And his book, The Methodology of Imam Ahmad in Detecting the Technical Errors or Deep Narrations, was published in 2004. And he has also co-authored the edition and production of voluminous compilation of Hadith, which was published by the Islamic University of Medina in 2014. He started lecturing in the Department of Islamic Studies of Adebayo University in 2006, and he has served as a permanent commissioner in Kano State Sharia Commission from 2007 to 2010. He was also a consultant on Islamic finance to the Financial System Strategy, that's FSS 2020 of the CBN, and later got appointed as a special advisor to the CBN governor on non-interest banking from 2010 to 2014. He currently sits on the Financial Regulation Advisory Council of Experts, that's FRACE, of the CBN as his deputy chairman, and is a member of the Takaful Advisory Council of Experts of the NICOM. So please make welcome for Dr. Bashir Aliyu as he presents his paper on the value proposition of Sharia contract. Dr. Aliyu, you're very much welcome. Over to you.
Okay, thank you very much, Temidayo. Bismillahir Rahmanir Rahim, Alhamdulillah. Assalamu alaikum and a very good morning to you all. The DG of SEC, the DG of the Pension Commission, ably represented by my younger brother, Dr. Umar Farouk Amin, the Secretary General of the IFSB, my friend, Dr. Bello Danbata, and my friend Abdul Qadir Abbas and the whole team in SEC and the invited participants in this webinar. A very good morning to you all. Could I have the chance to share my screen, or Zayanu will be sharing it?
Maybe we could just allow you to share the screen so you can control it more easily. So you can, in the interest of time.
Okay. Okay. Am I sharing?
Yeah. Yes, we can see it very clearly. Thank you.
Okay. The topic of my presentation is on the value proposition of Sharia contracts relating to Islamic capital market products. And the value proposition of Islamic finance in general is derived, in my opinion, from the higher objectives and intents of the Sharia, which are normally referred to as Maqasid Sharia. These higher objectives and intents of the Sharia, there are the general ones, and then there are specific ones. The meaning of these higher objectives are the existential and real aims of the Sharia. They are the objectives and wisdoms that are regarded by the lawgiver as fulfilling the aim of the Sharia in general or particular terms, and will lead to achieving the overall interests of Muslims as followers of the Sharia. One of the famous scholars of Islam, Ibn Taymiyyah, says that the fundamental objective of the Sharia is bringing about benefit and maximizing it, and eradicating harm and minimizing it. Benefit and harm are regarded on three levels, which are the levels of the fundamental objectives. The first level is the level of absolute necessity, and the benefits are the protection of religion, the protection of life, protection of intellect, protection of progeny, and protection of wealth. The harm, the opposite of these are what are regarded as harm at the absolutely necessary level. The second level is the level of needs. And these are to alleviation of hardship and relief of distress. The final level is the level of embellishment, which is the overall improvement of the Sharia and of those who adopt it. Now, when we come to the specific intents of the Sharia relating to wealth, four things could be identified. The first is wealth generation. The intent of the Sharia regarding wealth is that wealth should be generated and should be created. That is why enterprise is encouraged, as it says in the Quran, when the call for prayer on the day of Jum'ah is done, hearken to the call and leave off commercial transactions. Then it says, but after the prayer, then spread on earth and seek the favors of your Lord. So wealth is termed as the favors of Allah, the favors of your Lord, which shows an encouragement to seek wealth and also covet it. Among the intents of the Sharia regarding wealth, among the examples regarding wealth creation under the Sharia is that funds are supposed to be mobilized. The second Caliph of Islam, Sayyidina Umar, he directed a statement to the guardians of orphans, and he directed them to trade with the wealth of orphans so that the annual tax of zakah will not consume that wealth. That is, funds should not be left idle. The same with assets. Assets too are not to be left idle. The Prophet ﷺ, he said, whoever has a farmyard, he should farm it or give it to his brother to farm it or lease it out for farming. The second objective regarding wealth in the Sharia is the protection of wealth. Wealth is protected. That is why transgression against the wealth of others is regarded as a criminal act. The Prophet in his farewell pilgrimage, he said, your lives, your wealth, and your honor, they are sacred to you as the sacredness of this day and the sacredness of this town and the sacredness of this day. Also, squandering the wealth of others unjustly has been prohibited, which is why riba was prohibited, gharar was prohibited, excessive speculation, cheating, and unethical practices all have been prohibited in order to protect the wealth of others and also a person's wealth as well. The third objective is judicious utilization of wealth. That is, wealth is to be regarded as a trust. It is a trust because it was described as such by God. He said, spend from what God has entrusted under your care. So wealth that you receive is regarded as a trust. And the community has a right in private wealth, because Allah says, do not give those who are deficient in intellect from your wealth that Allah has made a means of subsistence for you. A means of subsistence for you, according to the scholars, a means of subsistence for the community. So your own wealth, the community has a right over. It is connected. Its benefit, the benefit of the community, is linked to your own private wealth. Extravagance is to be avoided because it is part of the non-judicious utilization of wealth. Also, avoiding utilization of wealth to bring mischief and disorder for the community and for the environment. In one of the Quranic stories where it was mentioned that Qarun, who was during the time of Musa alayhi salam, he had so much wealth, and his people told him that you should seek the hereafter with your wealth, but do not seek to spread mischief with it on earth. And Allah has also chastised the people who, when they turn back, they create mischief by destroying crops and destroying animals, which shows that wealth that is utilized to the detriment of the environment is not judiciously being used, and it goes against the fundamental objective of the Sharia regarding wealth. And then finally, among the objectives of the Sharia regarding wealth is that wealth should be redistributed and should not be in the hands of a few. As Allah has said, so that the wealth will not be circulating among the hands of a few. So in this, it is the fundamental objective of the Sharia that conscious efforts are made to lift people out of poverty. And this is where the tools of Islamic social finance come in, and the essence and the imperative of integrating Islamic social finance with Islamic finance in general. So coming to the contracts and their value proposition, these are generally the contracts that are used in Islamic finance. There are the exchange-based contracts, the partnership contracts, security contracts, benevolent contracts, agency contracts, and supporting contracts. The exchange-based contracts, we have under that, we have Murabaha, Salam, Istisna, Sarf, Bay, Ajil, Tawarru. We'll come to quite a number of them. Then there is also a lease contract, the lease contract of Ijara, which could be operating, financial, or Ijara fi Dhimma, which is forward Ijara. This table shows the classification and the mention of each of them, a continuation of the former one. The partnership-based contracts, you have Musharaka and Mudaraba. You also have benevolent contracts, the loan of card, a loan contract, a gift contract, a charity contract, an endowment contract, or an asset borrowing contract. And you also have security contracts, the contract of guarantee and the contract of asset collateral. And you also have a single agency, a contract of agency, which is Wakala. And as you saw in the presentation of Dr. Farouk, it is one of the underlying contracts in investment of pension funds, pension assets. Then you have the supporting contracts, the transfer of debt, set-off contract, a contract of dropping the right of a person, and then a contract of promise, which is being used widely in structuring. Yes, so with Murabaha is a sale of commodity or asset at its cost price with the addition of a markup as profit, where both the cost price and the profit are known to both the seller and the buyer. It is normally translated as markup sale or cost plus sale. It is a trust sale, thus the necessity for disclosure in it. The value proposition of Murabaha is that it has a positive impact on the real economy. This is through the facilitation of asset acquisition, the facilitation of trade financing, thus promoting cross-border trade and flow of funds. It is also a basis for structuring sukuk, which is an innovative asset class that uses real assets as underlying assets. You cannot create a sukuk without having an underlying asset, and normally Murabaha is one of the underlying contracts because it deals with the transfer of assets, the selling of assets as an underlying contract for structuring sukuk. It is also the basis for structuring financial assets. It's not that non-financial assets, they impact on the real economy directly, but financial assets too, they have their use. And Murabaha contract is used to generate funds and generate liquidity when you have a temporary liquidity crunch. And it could be, and it is the basis for structuring financial assets where you have a pool of assets that are supposed to be the underlying assets for issuing a sukuk. Examples are the Malaysian government investment certificate, government Islamic investment certificates, and then the ICD, the Islamic Corporation for the Development of the Private Sector. They have they issue Murabaha sukuk, and they do this with banks and other financial institutions as well as with governments. Creation of financial assets as components of an asset pool that satisfies the conditions for tradability, like in the IILM sukuk. IILM is the International Islamic Liquidity Management Corporation that is issuing short-term cross-border short-term sukuk denominated in convertible currencies for cross-border transactions. The asset pool, it has a ratio of 51% non-financial and 49% financial assets. You use Murabaha as the underlying contract to create the financial assets. Murabaha is also a source of financing for Sharia-compliant individuals and institutions of the society. This has been one of the greatest functions of achieving financial inclusion, because people who are looking for working capital financing, especially for the purchase of raw materials or other equipment for small and medium-scale industries, as well as for manufacturers, they resort to it for getting Sharia-compliant financing. And the fact that this Murabaha is widely used in the financial sector has made it possible for people to move out, for people who are disturbed in dealing with interest, to move away from interest borrowing to Sharia-compliant financing. This is indeed a very significant value proposition because it serves in achieving financial inclusion. Another contract is the Salam contract. It is a prepaid forward sale. It is you pay now and you take delivery later. And this contract, its value proposition is that it promotes financial inclusion. It has done so very significantly in the Sudan, because it was used extensively in farming along the shores of the River Nile, and it contributed in increasing the financial, in increasing agricultural production of cotton, wheat, and rice in the Sudan. And it was able to integrate hitherto people who were financially included into the formal financial sector. It also facilitates agricultural financing, and it gives access to finance by rural communities. And on a macro scale, it has been used as a basis for structuring Salam Sukuk, as the Salam Sukuk of the Central Bank of Bahrain, which has been in existence for over a decade now. It is facilitating liquidity management for especially Islamic banks and other financial institutions, using the trade of trading in aluminium as the underlying asset for this kind of prepaid forward sale. The next contract is Istisna. Istisna is a contract of sale of specified items to be manufactured or constructed, with an obligation on the part of the manufacturer or contractor to deliver them to the customer upon completion. It is applied in real estate project financing, in the financing of government projects, and in Istisna Sukuk. Its value proposition is that it will serve to close the housing deficit. It will it will close the infrastructure financing deficit. And it is the basis of creating new asset classes, especially in developing the real estate sector by facilitating the introduction of I-REITs, that is Islamic Real Estate Investment Trust. And you, as players and regulators in the capital market, you know the potential of this of these funds in improving, in achieving housing sufficiency in societies. The next contract is Ijara. Ijara, it is a contract of lease, and it is of three types. There is the Ijara of usufruct, which is the sale of the usufruct of an asset or a property. The asset or property that is leased, it belongs to the lessor. The lessor has the right to repossess the property when the lessee defaults. And there is also service Ijara, which is the hiring of the services of a person or another entity. There is also forward Ijara. This is a contract of lease of the usufruct of an asset not yet identified, but undertaken to be provided by the lessor according to agreed specifications. This example is the FGN Sukuk, whereby the issuer undertakes to to construct roads, which it will lease to the federal government, represented by the Federal Ministry of Works and Housing. And then the rentals that the federal government will be paid will be the coupon for the sukuk holders. And then at the end of the tenure of the sukuk, which is the end of the rental period, by pursuant to a purchase undertaking, the issuer that is standing in place of the sukuk holders will sell the rods to the lessee, which is the federal government, and then the price will be used to extinguish the sukuk, and the sukuk holders will recoup their principal investment. This is making use of this contract of forward ijara. Ijara has been used significantly, is the contract that is most widely used in structuring sukuk globally. And it has its application, even though it is related to only asset and equipment financing. But the sukuk, the ijara sukuk, they are wider than asset and equipment financing, because under ijara sukuk, even the service ijara has been used as a basis for issuing sukuk by telecom companies using their airtime as the underlying asset to create an income for investors, and therefore they are able to raise funds in the capital markets. The value proposition of ijara is that it facilitates infrastructure financing, and it closes the infrastructure deficit, especially in developing and emerging economies. We all know the statistics of the African Development Bank regarding African economies and their infrastructure deficit, and their advocacy for infrastructure bonds. These infrastructure bonds, the sukuk, ijara sukuk, they complement these infrastructure bonds, and they are a potential alternative for Sharia compliant investors and also conventional investors who want to diversify. Among its value proposition is that it has served to create a new asset class. And we heard from the presentation of the Secretary General, the development of the sukuk market, how it has developed and how it has impacted in making Islamic finance not only a niche, but a complementary financial system. It also strengthens the real economy, because ijara, it is not a financial, ijara relies on property, on assets, which to produce them, to construct them, or to make them, to take them out of idleness into active participation in the financial sector, it will have a real impact. It will have an impact on the real economy, because it will translate into job creation. We have seen it clearly from the report of the DMO regarding the use of the FGN Sukuk 1, Sukuk 2, and Sukuk 3, the numerous job opportunities that were opened up, which is a very significant impact. For the partnership-based contracts, we have Musharaka, Mudaraba, Musaka, Muzara'a, and Mugarasa. And the most commonly used are two, the first two, the Musharaka and the Mudaraba. It is used for trade financing, for project financing, for import and export financing, for running business, and also for working capital financing. And it is used to securitize asset financing based on a Musharaka basis. It is also being used widely in the capital market by Islamic mutual funds, private equity, and venture capital entities. Its value proposition together with Mudaraba, we'll take Mudaraba, then we'll take the value proposition of both of them. Mudaraba is a form of Musharaka, is a form of partnership. One of the partners is an entrepreneur, and the other are contributors of capital. The capital owner, he doesn't have a right to participate in management except if there is mutual consent together with the entrepreneur. It is a non-binding contract. Profit in the venture is shared between the managing partner and the capital contributors on a pre-agreed profit sharing ratio, and loss is borne by the capital owners, and the mudarib suffers for his work. Negligence, breach, or misconduct of the entrepreneur, if proven, makes him liable for the loss. Capital is not guaranteed, neither is profit guaranteed in this mudaraba. How are they applied together with musharaka? They are applied, they find application under mudaraba sukuk. And now with the implementation of Basel III for banks, the requirement to have additional tier 1 capital and additional tier 2 capital, especially for additional tier 1 capital, mudaraba and musharaka are the underlying contracts that are used to structure this additional tier 1 capital for Islamic banks. It is also the underlying contract used by Islamic funds. It is also widely used in takaful management, in managing the underwriting funds, as well as in managing the investment funds for both general takaful and family takaful. And it is also one of the basic contracts for managing pension funds. The value proposition is that mudaraba unlocks the value of idle assets. Just as banks do intermediate by having access to surplus funds and channeling them to deficit funds, mudaraba also does exactly the same, because you find people with idle assets, with idle funds, they could earn a profit on those idle funds by sharing in the risk, by sharing with another person in the risk of investing those assets, and they get a profit and they get a benefit. It's not like in conventional financial intermediation where you transfer the risk. You transfer the risk, you being the intermediary, you transfer the risk completely to the deficit unit, and you do not bear any risk. In mudaraba, there is risk sharing. But the same function that the conventional intermediation does of mobilizing idle funds, it is also one of the value propositions of mudaraba as well as musharaka, generally partnership-based contracts. Even the ones that I don't have time enough to refer to them, the crop sharing and crop growing contracts of musaka and muzara'a and mugharasa. These are all contracts that will have the potential of unlocking idle assets for production and for general economic benefit. Also, these contracts, they provide job opportunities to entrepreneurs with no access to finance. You have them, so many brilliant individuals active, but they don't have access to finance. Through mudaraba, whether at the level of individuals or at the level of financial institutions, at the level of the banking industry or the capital market, or even takaful, you are able to provide job opportunities for these young and brilliant entrepreneurs. It also facilitates the creation and growth of startups. And the startups, we've seen how they have been able to push economies to level of achieving very high growth rates, and also providing job opportunities to complement what big corporations and government are doing. One of the areas for getting financing for startups is using mudaraba as an underlying contract, as well as musharaka. It also diversifies risks through the new asset classes that have been created, because generally in musharaka and mudaraba, you are supposed to share in the risk of projects. Then the supporting contracts is the contract of wakala, which is a contract of appointment of an agent where a person appoints another as his agent to act on his behalf. Normally, it is qualified as a wakala bil istithmar, that is investment agency contract. And we saw from the presentation of Dr. Farouk, it is one of the underlying contracts in the Pension Commission guidelines on Fund 6 that will be used for the investment of pension funds. It is widely used as a contract. Yes, I am concluding. Yes.
Okay. Sorry. No, I don't mean. So please proceed, Doctor. I know you are concluding. I think that was just an unintended interruption.
Okay.
I was going to, yeah, but I understand you are concluding. You need to conclude now as well.
Okay, yeah. Wakala is widely used for structuring Wakala Sukuk, like the government of Malaysia, Wakala Global Sukuk, and there are many examples as well, both corporate, sovereign and sub-sovereign, and even multilateral. They have used Wakala effectively as an underlying contract, and the value, what it does is what the Sukuk as an asset class do by facilitating the impact on the general economy or on the real economy, as well as also opening job opportunities for entrepreneurs and for fund managers, for people that are active in the capital market. It is a very, very potent contract that they can use in structuring a lot of investment activities that they will do and earn a profit plus an incentive fee, which is normally the practice. So in conclusion, we can see that Islamic financial contracts, they achieve the higher intents and objectives of the Sharia regarding wealth and property. They serve to create wealth. They serve to give a judicious use of wealth, as well as they generate it, and they also serve to protect wealth. Regarding wealth distribution, definitely these contracts, they are for-profit contracts. They are not geared towards wealth redistribution. But when integrated with Islamic social finance tools of endowment, zakah, benevolent loans, and microfinance, they are able to achieve the goal of wealth redistribution, which is among the higher objectives of the Sharia. The value proposition of the contracts are the underlying factors for the phenomenal growth of global Islamic finance assets and the resilience of the global Islamic financial services industry. Definitely, the Islamic finance assets would not have achieved what they achieved of this growth if these contracts were non-existing. So it was what they have, the intrinsic nature and the intrinsic value proposition of these contracts. It is what has almost singularly contributed to this phenomenal growth, as well as the resilience of the global Islamic financial services industry, because these contracts are what has shielded the industry from being engaged in, from accessing toxic assets that would have affected the resilience and safety of their institutions. The Securities and Exchange Commission did the right thing in integrating Islamic capital market in its capital market master plan. And the pension industry, it stands to benefit from a lot. It stands to benefit a lot from the value proposition of these Islamic financial contracts. And even though they have started with Wakala bil Istifmar and Mudaraba, there are many other alternatives that could follow suit, these alternatives have been practiced in other climes and they have registered success and growth. Thank you very much for listening, and I hope in hindsight, I'm going to be thankful I will register my appreciation to SEC for inviting me to participate in this webinar. This was what I should have done. I should have said right from the beginning. And if it is possible, I just say a few words regarding what Dr. Farouk requested regarding the issue of guarantee, the ISPO. There is no problem with guarantee under Islamic finance. It is one of the security contracts. They are there to secure an asset. The only problem that Islamic finance has with guarantee is commercializing guarantee. Commercializing guarantees. When you give a guarantee or when you pay for a guarantee, we have a problem with that from the Sharia perspective. But even if you pay for it, it does not invalidate the contract. It will still be a valid contract, except that there is an element of Sharia non-compliance in the usage of that guarantee, but it does not invalidate the income that comes from the product that has been created. If it is a sukuk, like he has mentioned, the sovereign sukuk, that PENCOM will recognize if they have a guarantee, like an ISPO, that will not make the income from the sukuk be non-permissible. Like the Ocean State sukuk, the income is permissible, but they have a guarantee, which is an ISPO.
Thank you. Thank you very much, Dr. Aliu. We'll have to leave it there. Right. Thank you very much. Again, I noticed that a lot of questions are already being answered. Please drop your questions in the question and answer platform. And I noticed Dr. Amin, Dr. Umar, as well as others have been responding. Please, in order just to keep it straight and narrow, because I noticed some people have been responding to other people's questions, and which the computer or the platform recognizes that being answered. May I encourage you to drop your own questions, even if you have follow-on questions from one that has been answered, drop your own question and you may direct it to the appropriate person and it will be picked up and answered from there. Quickly, we'll just move on to the next paper. We have only 2 more to go, and this one will be more time conscious because we are trailing a little bit. I'll now call on Mrs. Abimbola Sulaiman, that's the head of investment at ARM Pensions, to present a paper on prospects for pension assets in the Nigerian non-interest capital market ecosystem. Ms. Abimbola Sulaiman will just present a paper. Over to you, madam.
Good morning, everyone. It's just 11:59, so I was trying to decide to say good afternoon or good morning. So good morning to everyone. I would first like to just say a very big thank you to SEC for putting this forum together, and as well to say thank you for giving me the opportunity to share the operator's perspective. It's been very interesting hearing from our regulators and from market participants, but from our seat as operators, we also have sort of different sets of challenges and opportunities that we see that we're very grateful to share, in this forum. Again, my very best regards to the DG of SEC, to our boss at PENCOM, Dr. Farouk Amino, and to everyone else who has spoken. Please accept my regards. I'll just share my screen very quickly. I will go through this talk.
If I could just hold you on a little bit.
Sure.
Dr. Aliu, you need to stop sharing your screen so we can proceed on the next paper. Thank you very much. So you may please proceed.
Yeah. So I will go very quickly through my presentation, especially because some of the areas that I touch on, have been addressed by one presenter or the other. If you could please confirm if you can see.
Yes, very boldly.
Excellent, thank you. So I'm talking about the prospects for pension assets in the Nigerian non-interest capital market ecosystem. We're all aware of the progress we've made. I'm Abimbola Sulaiman, as you know. Just some background information before I proceed. Of course, we've heard the statistics. It's 12 trillion in assets at last count. I want to highlight that only about 80% of that is in the retail funds. So the retail pension funds, RSA 126, which we are talking about today, is really not 12 trillion. The entire scheme is 12 trillion. Retail funds are just below 10 trillion naira as of today. Registration is about 9.3 million individuals as of April 2021, and the assets represent about 7.9% of GDP. So of course, it's a large pool of assets and really the largest investment pool of assets in the country today. But we always try to emphasize that we're still scratching the surface. There's still a lot of opportunity. There's still a lot of untapped potential for the pension system to grow in Nigeria. On this chart just shows the history where we started from in 2004. The only thing I would want to highlight here is that while the assets have grown steadily, growth in number of contributors have really started to plateau and now very low single digits annual growth in contributors. Of course, the challenges with the economy and the labor force itself is not growing, as fast, and you're seeing that impact on the pension scheme, where assets are growing month on month, but the number of contributors is now starting to stagnate a little bit. Major industry developments, and I'll get right to the point. Of course, you heard about the multi-fund structure, which birthed this non-interest fund that we are discussing today. Before the non-interest fund was launched, it was the micro pension fund, RSA Fund 5, that was launched first. Beyond the multi-fund structure, of course, some of you are aware now that the option to choose and switch pension fund managers has kicked in as well. And the newest development is a minimum pension guarantee. This is for retirees who opt for a program withdrawal from their PFAs, who now enjoy the benefit of the minimum pension guarantee after retirement if they do run out of assets. And so the challenges the industry is facing today, of course, I mentioned low coverage already. Negative real return and devaluation are linked, because if you look at the performance of assets, while we've sort of consistently posted returns industry average in the low to mid teens, that hasn't been able to keep up with the high inflationary environment that we have been experiencing, and of course that's concerned. The primary goal of any pension scheme is really to preserve savings and purchasing powers for the contributors. There's a dearth of investment outlets. We can discuss that a little more as I go down the slide. And then there's inadequate awareness. Beyond that, you still have a little bit of non-compliance, but I think primarily the largest pool of employers that are not participating in the contributory pension scheme today are the state government civil service, federal civil service to a large extent, and qualifying private sector to a large extent have embraced the scheme, but you still have very high number of people working for state governments that are not covered by the contributory pension scheme. Of course, this is the lowest hanging fruit that you can identify if we are thinking of expanding the scheme and expanding coverage. So quickly to the point, we talked about the launch of the multi-fund structure and this excitement and fanfare that is accompanying the launch of Fund 6. What we have seen and what we have experienced is that uptake for funds that are optional or not default has been very slow. So you can see that the bulk of the assets remain in RSA 2, 3, and 4, which are the default funds. So if you come to your PFA, you are going to by default be placed in Fund 2 or Fund 3 if you're still working, and if you're retired by default to Fund 4. And the concentration of assets is in those funds. All the new funds that were introduced with the multi-fund scheme, so RSA 1, the micro pension RSA 5, and the just launched non-interest fund RSA 6 are optional. The contributor has to request to go to those funds, and it has been very low. Engagement is low. I think that what you see is that for some people, pension is, something that they should think about in the future. It's not front of mind today. Of course, there's a lot more as operators we can be doing, the regulator should be doing to sort of increase this awareness and push engagement with the client base. So as of now, the RSA Fund 1 in its totality is about 35 billion naira, and the RSA Fund 5, the micro pension fund, industry-wide is only 185 million naira, give or take, much less than $500 million. And so if you look at those numbers and think about the prospects for RSA Fund 6, you may be concerned whether or not we'll have the same experience, being that Fund 6, both the active and the retiree legs of the non-interest fund are optional for the client. So as operators, there's a little we can do to deploy assets if the contributors are not actively opting to be in these funds. But for Fund 6, I guess I want to then caveat what I said with the fact that you would imagine that Fund 6 would fare better in terms of adoption, given the fact that it should be pushed by sort of a strong value-based intent behind the adoption. So the people who want this non-ethical fund tend to have this to be sort of a core tenet of their value system, of their beliefs, and will probably more actively engage to switch. So I looked at other markets. Dr. Danbata mentioned earlier the UK and the volume of assets that the pension scheme there is forfeiting due to the fact that many of these schemes are not Sharia compliant. The Times UK reported earlier this year that about as many as 30% of Muslims opt out of workplace pensions in the UK just because there is not an availability of options that align with their religious principles. So if you think about that, that might be a benchmark to think what the potential level of adoption might be, in a country like Nigeria. And it also demonstrates the fact that the launch of Fund 6 is really critical in this market, because here we do not have this option to opt out, right? So everyone has to be in the pension scheme if you are working for an eligible, employer, and whether or not a halal option is offered, you are in the scheme. So it's really timely, and it's great, initiative from PENCOM really to put that option out there so that people are not forced to be in products that they don't want to be in. There's been this argument that it could be a driver of financial inclusion. We would still have to wait and see, about that, because as it is today, it's really the members of the existing scheme that get to opt to go to Fund 6. It's not yet very clear that the launch of Fund 6 itself can drive increased adoption of the CPS in aggregate. So like I said earlier, our state governments are really the biggest employers of labor that are not, a few state governments, right? Not all of them, that are not in the contributory scheme. And when you speak with them, very few of them are saying we're not participating because there is no halal option. It's never been the case that we've heard that the lack of a Fund 6 or a non-interest product has been a reason for people not to sign up to the scheme. So it's our belief that this is something that is there to meet the needs, or to better align and meet the needs of existing contributors. And it's not very clear to me how this can drive increase in number of contributors in the scheme in general, given that it's a compulsory scheme anyway. On my next slide, I talk about just globally how have Islamic pension funds fared. In financial services in general, this ethical or non-interest pensions is really the slowest and smallest segment of non-interest investment products. So I don't even include non-interest banking, on this table. I specifically focus on asset management products. In mutual funds and ETFs have really outstripped growth of pension fund assets in non-interest evolution. Even insurance and the takaful has really grown faster than non-interest pensions. So the data that I have here is a little bit still from 2018. You can see that non-interest mutual funds, about $97 billion globally. ETFs, just a fraction of that. And then takaful funds valued at $2 billion on the asset management side. And non-interest pension funds, specifically less than $1 billion, just 370 million US in 2018. So it's a very small market globally. It's a small nascent market in Nigeria. And what might be responsible for this beyond maybe that data collection issues? Because one of the things you will know, our pension scheme is modeled around the Chilean system where, it's direct management of pension funds. In a lot of markets, pension fund managers really do just manage a selection and outsource the investment management process to other asset managers. So it might be the case that of this 97 billion you are seeing in mutual funds, a whole fraction of it might be coming from pension funds that are allocating to non-interest mutual funds managed by other asset managers. And then when you look at predominantly Muslim countries, the institutional setup of pension schemes is not that structured. It's not as advanced as what you're seeing in OECD countries, or even a place like Nigeria that is modeled around a very sophisticated system that was launched in Chile. Many of these countries still rely on social security or defined benefits, government-run pension schemes that are not segregated. Therefore, when you look at the classification, you don't really see halal pensions and non-interest pensions as a massive market because of this categorization issues. So if you look at the top 300 pension funds globally, only 3 pension funds from 2 countries are listed in the global top 300. These are halal pension funds. There's only 3 in the top 300, and 2 of those are from Malaysia and then 1 from Kuwait. So, but it's clear that, this is an area that's going to grow. And as that wave happens, globally, Nigeria is sure to participate in that growth and follow through. So you will see a gradual conversion of existing, conventional pension funds. The article that I highlighted earlier from the Times, which says about 30% of Muslims are opting out of workplace pensions in the UK, was around the launch of a halal pension scheme in the UK that's run by HSBC. And you're seeing now increased adoption, because when people are offered that choice, then they are participating. So you will see that gradual conversion of existing pension funds, similar to what we're going to have in Nigeria. And then you might have reform of social security system in predominantly Muslim countries. You can see the direction that Saudi Arabia, for example, has gone in sort of economic reforms and privatization, and trying to restructure the economy a little bit away from overt dependence on oil, and therefore cut back on some of the social security, or very generous social security benefits that they have. So it will go with the reason that many of these countries will start to institutionalize pension fund management as well. And then you will get increased awareness from Muslims living in, be it Western developed economies, but all over the world, really, like increased awareness amongst Muslims and the imperative to use Islamic products as much as they can. And then the biggest wave really in traditional asset management today is ESG investing and responsible investing. And that has been so, it's really dominated conversation around innovation in asset management. And if you look at the tenets of ESG and responsible investing and the tenets of non-interest Sharia investing, they are really aligned and quite intertwined. And so as that philosophy grows, I think you will see that be a potential growth driver for non-interest investing, non-interest investing in the pension space specifically. So for us as operators, what are we doing and what's front of mind and what are we thinking about? I think the biggest acknowledgement that we have to make is that this launch of Fund 6 and the management of Fund 6 will require really a radical shift in mindset in how we do things. This conversation already came up in the forum where a lot of people have asked, why is it all about sukuk, and it's because we've come from this very fixed income government bond predominated, the default asset class for the pension scheme has been FGM bonds. And people have found safety in and comfort in buying FGM bonds to as much as the regulation, allows. And as Fund 6 is being launched, I'm concerned that we're taking that same mindset to manage Fund 6, which is we want to do exactly what we're doing in Fund 2, but just, attach sukuk to the name or call it halal, but do the same thing. And that's not going to, I don't think that that's the intent behind the launch of the fund. It probably will not meet the needs of the investor, and it's not in line with the spirit of non-interest, investing. So if you look on the table that I have to the left, just talking about where pension assets are today, it's just highly dominated by FGM bonds. And, we all know the reasons why. There are 12 trillion or market capitalization of FGM bonds outstanding today, about 12 trillion naira, and 7.8 of that is owned by the pension fund or the CPS, so 60% of it. And in contrast, the listed equity market is 21 trillion, so almost twice the size of the FGM bond market, but pension scheme ownership in listed equities is less than 1 trillion, so just about 850 billion or 3.9% of outstanding market value. And to the FGN Sukuk, which DG Sec mentioned in his speech, pensions owning just less than 80 billion naira in Sukuk. Again, you have to then sense check that with the value of Sukuk outstanding, which is 360 billion. So 20% of FGN Sukuk outstanding today is held in the pension scheme. And I would argue that at the time that these Sukuks, FGN Sukuks were launched, there was very warm reception from the pension industry, I would say. And this number is that low, not because of a lack of demand. There's the Sukuk, very heavy demand from retail, from non-pension asset managers, and many of us could not even get our orders filled. And so as we now go into, I would say that perhaps this number could be close to that 60% you see with FGM bonds, if FGM Sukuk issuance was to pick up pace and become as regular as traditional FGM bond issuance is. Where there is, I think, a misalignment is looking at non-interest products outside of Sukuk. So all of the contracts that speakers before me have mentioned, and all of the products that are in the market today. So there is an ETF, there are halal mutual funds, there is a REIT today that is Sharia compliant, and the conversation, we as operators have to be ready to engage with those products and have those conversations and engage more with the listed domestic equity market to the extent that those listed companies can meet the Sharia compliance threshold. Because again, it's easy to say that market cap is 21 trillion, but we know that our market cap or our equity markets predominantly dominated by the banking sector, which you would have to strip out, immediately the traditional banking sector. So, but still there is, the NSE 40 halal index, where there are quite a number of listed companies that will meet Sharia compliant threshold, and PFAs have to be ready to engage with the equity market to an extent that is beyond what we are currently doing today with the traditional retail funds. So I put it here just to illustrate. I know that Dr. Farouk already mentioned the rules and the limits from PENCOM for PFAs to operate by. But if you look in other markets, actually, Sharia compliant funds tend to be predominantly equity-based and not income-based, be they Sukuk or not. So that comes with a bit more volatility than our market is used to, a bit more reorientation is needed. And in the long run, it may be that we are actually better off with a bit more exposure to non-income type instruments because of the highly inflationary environment that we live in. So this excerpt that I post here is from the HSBC Islamic Global Equity Fund that is offered to pensioners in the UK that opt for a halal product. It's a 100% equity fund. While in this market, we are not allowed to go 100% in equity, our predisposition to be at very low single-digit exposure will probably have to be reviewed and revisited. On my next slide, this is just the penultimate slide. As I talk about the bullet points here, I'm talking relative to what we are doing currently in the traditional RSA 2, 3, and 4. I think that with Fund 6, again, I say it's a radical shift in investment mindset. Like I mentioned earlier, in a lot of markets, pension fund administrators tend to outsource investment management. They focus on manager selection in asset classes. We do that as well when it comes to things like private equity and real estate. We are reviewing fund managers and allocating assets for them to manage. It might be that that is what is required in this space as well, is more reliance on specialist investment providers, third-party providers. So mutual funds, ETFs, all of those are permissible in our investment guidelines today and collective investment schemes, but we use them to very little extent in the traditional RSA products, RSA 2, 3, and 4. I think that we've got to be a lot more open-minded to outsourcing Fund 6 to fund managers that have the expertise and track record and experience in managing these type of funds, because again, it's specialist knowledge. And with the fund managers myself, sitting in a PFA and heading the investment team, I'm making fixed income investment decisions, equity decisions, real estate decisions. And the reality is that nobody is such an expert in making decisions in multiple asset classes. And faster we recognize that and understand that there are experts in this field and allow them to provide those services for us as our regulation permits, I think the better it would be for everyone. I already touched on the second bullet point, but just to say it again, that we have to be open-minded to having higher exposure to variable income instruments. And this very fixed income and guarantee minded. While we know that we are risk conscious, this is a pension scheme and we want to be very risk aware, we also have to understand that the tenets of non-interest investing is not really compatible with the mindset that wants, everything to be predictable and guaranteed and fixed income and all of that. Again, I think PFAs have to demonstrate to contributors that there is a clear differentiation in strategy and outcomes for this fund. I think it's going to be difficult to sell this concept to the people who want it. I mean, I guess it's a value-based, so we are not selling, it's a value-based choice, but we would not be meeting their needs if all we're doing is doing exactly what we do today and then purifying the income. I think that it has to be demonstrable that you are managing this fund in a clearly delineated and differentiated way to comply with the principles of non-interest investing, and the outcomes should reflect that as well. And then to the sell side and to other capital market operators, I already mentioned earlier that we would have to have significantly more collaboration in this kind of fund. But what tends to happen, especially when a new window, a new asset class emerges, so for now, RSA 6 is here and it's an opportunity for asset managers to create products, in that line. And you may see sort of a rush, come one, come all, everybody sort of presenting a product and calling it a non-interest product for pension funds. So there must be a clear demonstration to operators that we're not going to have a lower bar for quality or a lower bar for risk management or expected returns just because this is a non-interest or Sharia compliant product. So we would still insist on the higher standards of quality and of risk management and of, track record and all of that. And
okay, I need to, sorry to interrupt you, Ms. Sulaiman, I need to hurry you a little bit along now.
Okay, excellent, thank you. And I think this is the last slide, so I'll just go on. And then I think the only important thing I should say is then a willingness to back and invest in new product structures and managers. I think in the past, we always say we want to see a long track record of the manager, of the product, just show me the history. And we must recognize that this is an emerging asset class in this country, and therefore we must be open-minded after satisfying our quality and risk management requirements to back new products and support new managers, support new structures in areas that are permissible in our regulation. So I'll just wrap it up here. I'll leave the slide up while I wrap up because it's the final slide. I'm just looking forward, thinking about what we should do. Of course, a focus on expanding coverage, because the conversation today is largely about sharing the existing pie, and we must think about how to grow the pie, not just how to split it into multiple funds. Increased government support around regulation and legislation. Some of the speakers earlier mentioned some uncertainty or lack of clarity around tax treatments and things like that. That's where we would need government support and more will from the government to issue these types of products. And then capacity development in our industry, but across capital market universe in aggregate, improve the ecosystem and education of the ecosystem. When I say the ecosystem, not just the contributor, so the media. So today, if you go on the internet to look for PFA performance, you will be seeing all kinds of data and noise. People tell you this was #1 last month, and they're looking at weekly volatility and monthly volatility, and you can't have that mindset when you manage these types of funds. So just a reorientation of all of us, and then closer collaboration, just like we're doing here with the regulators, with operators, just working hand in hand for what is a common goal and a common priority. Again, thank you for the opportunity to speak, and I hope that I haven't taken too much over time.
Well, it's time. One thing I can tell you, I won't comment on whether you took a lot of time, but I'm sure it's time very, very well spent. I'm sure there's some fund managers here, being something that I've always done before being on the regulatory side, and I still have passion about. Two things you said that jumps out. PFAs or PENCOM may need to start looking at allowing specialist fund managers take care of some of these worries. So at least if there's convergence in thoughts about the deliverables and the returns, operations and how they do, and I know, and that's one of the key things PFAs, and I hope other members of PENOPS are on this platform as well. In fact, that light slide before this one, that slide 11, I think it's something that all fund managers should grab, screen grab, and just put it on, and maybe like laminate it and start showing it anytime they're having a presentation with PFAs. And I like the part you said, the willingness to back and invest in new product structures and new managers. It will open, it's a catch-22 situation. And some people will get better when you give them the opportunity to keep doing it and keep refining as we go along. On that note, Mr. Abimbola Sulaiman, I really do thank you. And I'm sure we'll, if you please, and for other paper presenters, please look into the Q&A box, start answering live so we can cut back the time. And for people that are asking questions, I particularly like and appreciate the way you've been directing it specifically to each presenter you rather would answer your question. That's very helpful in the interest of time. And I think it gives that personal touch and effect and then allow them type something you can read over and over again. So on that note, thank you very much, Ms. Sulaiman. And our last paper for today will be delivered by Mr. Ndako Mijindadi on behalf of Mrs. Hajara Diola, who is the chairman of the Non-Interest Capital Market Committee for the Securities and Exchange Commission and the MD, Managing Director of Lotus Capital. Ndako, while I'm not sure they included his profile here, is someone I've known. He's been quite vibrant, quite seasoned fund manager on the sales side. And I'm sure he'll have a lot of perspective to share. And especially, and I like the sequencing that Mrs. Sulaiman spoke before him. And I think there's a couple of nuggets he and other fund managers will pick up from here, just as we collaboratively work together to make sure we make the non-interest capital market, assume the platform it should be in our capital market. Over to you, Ndako. Thank you.
Right, good afternoon, and thank you, our commissioner, Mr. Temidayo Obison. I'll just like to say a big thank you on behalf of my MD, Mrs. Hajara Diola, for being invited to this program. It has been very electrifying, if I must say. The deliveries have been very on point. And I think the SEC deserves a very big applause for bringing everybody together. I also like to thank everybody for staying on to witness this event. Great. I'll do my best to fit into the shoes that I have been given, and God help me. Right. So please let me know if my screen is up.
It is very visible. Thank you.
Fantastic. Right. So very quickly, I'll be taking us through the non-interest capital market instruments as an alternative to liquidity management tools for pension assets. Now, during the time that we were listening to the conversations, and one of the earlier speakers had mentioned that we will get to a point where our view of non-interest instruments will not necessarily be as an alternative, because it will become complementary. Right. So even though my talk now is relative or is related to it being as an alternative, we think strongly that it is a complementary liquidity management tool for investment. So I was speaking to it as general investment, not specifically only on liquidity management, because there are various other things that non-interest management capital market tools can do. I know a lot has been said about the global market, so I'm only going to touch on one thing that I noticed from the data on global market statistics. Now, I'm taking my data from the Islamic Finance Development Indicator. They have the report that was published in 2020. A lot of the data comes from 2019. Some of that data comes from 2020. Now, what they have said specifically in that report is that the coverage of Islamic pension assets by many of those who are reporting in their surveys has been done under Islamic asset management. So when we look at Islamic asset management, we're seeing Islamic pension funds covered in that. And that speaks to some of the things that we've also been saying, that in many domains, there is this marriage that happens between the pension industry and the asset management industry. So let's say what happened in the Islamic asset management industry. Now that we understand that it does include pension assets, at least as far as the Islamic Finance Development Indicator is concerned. Now, in 2019, you had over 100 funds that were launched. with a focus on Islamic asset management. And this include the mutual fund focus, the pension funds, insurance funds, and ETFs. Okay, and we have seen that growth. Now it allows us to have a better view as to the size and capacity of Islamic pension funds and Islamic asset management in a broader context. So we're now looking somewhere around 140 billion in terms of size as of 2019. If we're looking at the rate of growth, then it's easy to say that with 2020, that growth would have been apparent. So wanted to clear that. Other thing that I think would be nice for us to look at is how exactly some markets have fared. If we look at the predominant Muslim markets, so there's the Saudi Arabia's, there's a lot of pension reforms, and I'm very happy we've spoken about it there. So there is still a significant size that is yet to hit the market in Islamic pension assets, right? But if we look at, for instance, Pakistan. Now, Pakistan has investments in Sharia compliant funds. And if we look at data that has been released by their foremost credit rating agency there, in 2020 alone, we saw a growth of about 214 million in assets within the pension space. Now, more than half of that, right, were assets of Sharia compliant pension funds. Okay, and I mean, I don't need to give anybody an explanation of what Pakistan as a market is. In Indonesia, for instance, we see that there are companies that provide pension investment or share compliant pension investments. And if we look at the total size of their investment industry or their pension industry, that is also significant. I'll just bump up into Malaysia. Now, Malaysia for us, many people see it as the most advanced Islamic finance market. However, it's until 2016 that we started seeing state-sponsored pension funds in Malaysia, right? And we've seen significant increment in how pension assets grow within that space. At least in 2020, we saw it grow as high as 7 to 8%, right? So this is just information beneath the numbers because of how things are reported. So sometimes it's not very apparent, but we can dig deeper and see some of these things. We've also mentioned about how pension funds are being adopted in the likes of other places like Australia, United Kingdom, and places that you would not expect to be, I'll say, very focused on non-interest investing, but do have a significant component of non-interest specific contributors that we can leverage on. If we say our market is going to play this or follow this type of trajectory, then there's comfort, you know, that most of the things that we've been saying can actually do come to pass. And honestly, if you take us many years back to when the Non-Interest Capital Market Committee was conceived, where we are today in Mr. Joseph's view is a dream, right? Where we are today is a dream, but we are here today, and a lot of the actualizations that we've been realized is because of all the work that we have put in, and clearly it is going to take us to where we hope to be. Now, another thing that I thought to open up in the numbers again on the global side is on where are the assets. We've mentioned investments in Sukuk and why there's a lot of mention in Sukuk, but I think we also need to specify that even within the Islamic asset management space or the pension market, you would still see Sukuk as a dominant asset class. But Sukuk is not one type of instrument. Sukuk is many things, okay? We say Sukuk, but as our teacher, Dr. Bashir, helped us to understand, there are different kinds of structures and Sukuk. Right? They are the istisna variants of Sukuk that help you with construction. There are Sukuk that are based on rental. There are Sukuks that are used for agriculture. There's so many types of Sukuk. So while we're saying Sukuk, we're not referring to just one type of Sukuk. We're referring to the basket of Sukuk that is possible. So yes, Sukuk will be a dominant feature, and we have seen that. That is not to say there is not significant investment, as you would see, in other asset classes, be them in equities, right? Be them in real estate, okay? And the likes. Now, in our own market, what we have seen is that our growth has not been by happen chance. The growth of this market has been very deliberate. It has been very deliberate through events, advocacy, work, by many of the people, that are here. And I want to speak to the SEC because what the SEC has done is phenomenal, not only in developing the Capital Market Master Plan, but in the implementation of that plan. Alhaji Abbas mentioned a number of things, but I don't think anybody understands the amount of rigor that goes into each of those initiatives. If I look at the Sukuk market that we see today, that we think is small because it is about 362 billion from the federal government side, it takes a little bit of humility to understand, at least from us, how we even got there, right? This involved trainings, this involved seminars, this involved market education, this involved a lot of hard work from the regulators, from industry advocates, from even in the investor base, like the pension funds. A lot of work was went into getting to the level that we are. But now that we are here, there's a lot that we can still do to move us forward. There has been a lot of focus on the ethical component and the structuring of instruments. However, in our view, and this is a view that we maintain anywhere, is that there should not be any compromise in terms of quality, in terms of profitability, because of considerations or people trying to invest in line with their values. These things can go hand in hand. Non-interest finance is not to make you poorer. The part of the objectives of the Sharia, which Dr. Bashir elucidated on, is the preservation of wealth, economic progress. So there's not going to be a situation where you would say, look, because of ethical considerations or because of non-interest considerations, there should be a premium or a discount or what have you, because of that. And there's a testament to this. For the non-interest funds that are in the market, their performance can be compared to the performance of the conventional. And so you can see, look, is there a discount that is being that occurs on account of ethical investment? And the answer, would come back to you that no, you can put instruments side by side. All right, we're quite happy on the full adoption of non-interest finance by the pension industry, right? And for me personally speaking, it's not only because the PFA, the pension industry, controls the largest asset pool in this market, no, but because the pension industry has the potential to cover a very wide demographic, all right? It also is very properly regulated, is very structured. The funds are managed, as you have seen here by my earlier speaker, by professional institutions whose diligence is beneficial to the market, to the non-interest market in totality. There are a number of associations that have come together, especially within the non-interest space, to drive this market. So I'm quite happy for where we are. Now I'm going to speak to where we are today in terms of the breadth of non-interest finance, non-interest capital market products, or non-interest products in general. Now, it's easy for us to say, look, the pension industry is about 2 trillion. I'm very happy to my sister Bimbola for clarifying that, or letting us know that within the active segment, that's about 10 trillion, right? So it's easy to say that the pension assets are significantly larger, and we see this than the non-interest finance assets. Within the numbers for non-interest finance assets is also the pace of growth within the market. So if we grow and we can continue to maintain the momentum that we're going at, with everybody's involvement, with the level of advocacy and collaboration and that we're seeing, this gap will close. This gap will definitely close. I'm saying it that we're on the right track, right? So in the Sukuk space, we had an issuer that is the largest issuer in the country that has adopted Sukuk. It has not only adopted Sukuk for a one-time issuance, it has adopted Sukuk repeatedly for 3 issuances, okay? Obviously, there were issues around size, and some people got cut out of the market because the offer wasn't sizable, but lessons were learned from that. And we saw an uptick in the amount of Sukuk that was available. Now, why is the Sukuk just about 362 billion that has been issued by the federal government? Another thing is because we are very deliberate to make sure that we achieve the intention of non-interest finance, which is to make sure that the Sukuk and the instruments are tied to real economic activity. Now, to do that, you have to have valid projects that can go into Sukuk offerings. Now, there are synthetic type of arrangements. The DMO has been very deliberate not to have synthetic arrangements, right? And has tried to make sure it achieves that element of economic development through Sukuk as a primary instrument. okay? And this is something that we expect to grow. Within the asset management space, we started at the time, 2008, one asset management company, right? Or one mutual fund, right? In the last year or slightly over a year, we have seen significant growth in the asset management space. We now have 10 mutual funds that the SEC has registered. Now, these funds, be them a focus on equities, be them a focus on fixed income and sukuk and equities, right? Some of them are managed by prominent asset managers that you know, that I know, that we all know, right? So in terms of the expertise of management, it is there within these products, right? We've seen developments within the banking space. We've seen a growth of a number of growth in the existing number of participants. We've also seen new participants coming in and offering investable products. When I say investable, is because money market instruments and placements with non-interest banks is also a significant area that can be explored for investment, because these banks or these non-interest financial institutions have good capacity in generating assets. They serve as a very significant financial intermediation tool. So today, we have an industry in terms of the asset breadth. We have sukuk, we have mutual funds, we have equities, ETFs, we have money market instruments in the form of bank placements and a number in development, and we have an Islamic REIT. Now, I want to speak a little about the Islamic REIT. And the reason is, there's huge potential in real estate. There's huge potential in real estate when done properly, at least from an investment standpoint. For those that travel down the road, you would see a lot of funny real estate claiming type of things. It's very unclear who the managers or who the developers of all these real estate are. So if we say that real estate is a significant component of non-interest investing, or real estate is a significant area, where we can apply non-interest instruments, then the manner in which that is done has to be very structured through things like REITs. REITs are regulated. REITs are professionally managed, right? REITs provide a level of liquidity that is needed by investors that might not happen with direct investment in REITs, right? So for us, a REIT, an Islamic REIT, is a very strategic development for this market, which is why we're very happy to participate on the transaction. It's very critical, and it has allowed us deepen the breadth of investable assets today. Now, if I look at the Funds 2 structure and say, look, there is going to be at the beginning, or even for times to come, a perception within the pension industry to replicate Fund 2, right? I'll say this is our vanilla type, right? To replicate that kind of structure with a Fund 6. And we ask, what is the composition of a Fund 2? Where is the market likely, or where are the assets likely to be allocated? We would see FGN bonds, we'll see bank placements, we would see equity components, we will see short-term instruments, right? Like treasury bills. We will see some corporate bond focus. We still see this 5% allocation to corporate bonds and on other assets. And this is, at least my data is from earlier this year, but much of the structure, as far as I research, is similar, is very similar. Can this structure be supported by development within non-interest finance? My answer is yes. Can we go further than this? My answer is also yes. So we can replicate, we can achieve it if that is what the investment market is saying. We can go further than it if we push ourselves, which I think we all can, with the level of work that we've already put into this market. So if we disaggregate what goes into a non-interest portfolio, from the equity side, there is work that has been done in creating the NGX Lotus Islamic Index. Now, this index tracks the performance of Sharia-compliant equities that are listed on the Nigerian Stock Exchange, and the data, which is very important for institutional investors, goes as far back as 7 years, right? This allows for modeling, forecasting, even to understand how instruments or securities came in and out of that index. It is a knowledge trove that exists. There are instruments in the form of an ETF that has been constituted on the back of this index, takes away all the issues that would be, or all the hassle rather, for reconstitution and rebalancing that will exist if one was managing an individual portfolio, and transferred all that into a listed instrument. Now that is available. in terms of the size or capacity for how that market or that equity portfolio can grow, it is very similar to the equity market itself, because you have some names, and I've put up some of these names to show how we can identify with them, right? Some names that as at today are compliant with share requirements, the likes of Dangote Cement, the likes of BOA, the likes of the most capitalized companies of the exchange, the likes of MTN, Dangote Sugar, Nestle, what have you. Now, the expertise that is required, like I mentioned, has been covered by the index. There are various things that we have to be sure about. We have to be sure about the principal activities of these companies. We have to be sure about their financial structure to make sure they're not highly geared. We have to be sure that their assets are largely tangible. There are a number of criteria that makes a security or an equity compliant, but these equities exist. Instruments built to track and invest in these equities exist. They can be replicated. We can have multiple ETFs built on the back of this index. So I would like to say that if we want to go the route of building an equity component within the portfolio as a tool, and the equity index is useful as a tool, the ETF, the Islamic ETF that is listed is a very good tool. Now, other things around mutual funds. Now, I'm a fund manager, so every day I would be looking at investable assets. Now, part of the things that we do at Lotus Capital is to make sure that we are very involved in the entire process of market development. So we have a good view of the assets that are coming to market well before the assets even come to market, such that we can grow these portfolios, right? We're looking at asset sizes somewhere about 40 billion for the non-interest funds. We're looking at about 10 mutual funds at the last count. I've also shared, just the top 5 of those. Now, what is interesting is how the assets have grown within this space. We've seen in 2020, for instance, in the size of the market, we saw drawdowns from the conventional. We saw increments in the non-interest mutual funds in terms of their size. And that's just because of the amount of new entrants that have come. If we look at the focus of this non-interest funds, we have one equity, we have one REIT, we have 3 that are fixed income, we have some, that are a blend of fixed income and equity and other assets, right? Now, I believe we're seeing at this pace of growth where more fund managers would begin to develop these kind of portfolios. We have over 100 registered fund managers. So that also tells us what kind of scope is possible. It's important, obviously, to make sure that there's a lot of diligence that goes into managing the non-interest portfolios, to be sure that there's a lot of expertise or the required expertise is there in the management and the identification of assets. Now, why do I say this? There are certain risks and opportunities that exist with non-interest assets. Aside your regular risks, there are risks around tradability and liquidity. There are risks around Sharia non-compliance. It's good to have a good lid on these type of things, which is what a professional asset manager can provide. There are risks, there are opportunities in terms of profit that can be made from investments just because of how a contract has been structured. It's good to have a good view to see what the upsides and potential downsides can be when going into such type of assets. A professional asset management company can do that. And these mutual funds, like I said, are available, and we believe that they're going to grow. Now, for the money market, one significant development that we have seen is in the activities of the non-interest banks. We have seen them grow as well. We have seen them mature, most importantly. We have even seen the credit quality of some of these institutions improve, verifiably improve. For instance, if I look at Jais Bank, we've seen Jais Bank obtain an investment grade rating from Augusto & Co. Now, Augusto & Co is very rigorous, right? To attain an investment grade rating is not easy. So for the bank to achieve this level, we're quite happy to see that kind of development. It speaks to improvements in financial performance. It speaks to growth of the entity. It also provides a guide for other non-interest banks to follow. It also serves as a very important way of benchmarking performance across non-interest banks. Now, what does a vibrant non-interest banking segment do for the market? It does seriously well for placements. It does seriously well for things like bankers' acceptance, and other money market instruments, because it enhances the profile of those instruments. So we're quite happy with all the developments that we've seen. We've seen additional banks, come on spring, the likes of Taj Bank, the likes of Lotus Bank, and we hope, that the market will become much stronger to take additional investment. Now in the Sukuk market, and I have pushed my Sukuk towards the end of the conversation because a lot has been said about Sukuk, but not enough has been said about Sukuk. And why do I say this? What has the Sukuk market achieved aside from 362 billion in issuances? The Sukuk market has, because of how the instruments were paced, and because it was the same quality of issuer, because it was the same quality of issue using the same type of contract, what we're looking at is a similar risk type of instrument that has a yield curve that is beginning to emerge, right? As time goes on, it will emerge much stronger, and we can begin to price off this. Now, this had been one of the fundamental, I'll say, intentions of the non-interest capital market master plan that has easily been achieved, right? You have a benchmark yield curve, so to speak, right? That you can begin to see issuances on the back of. You can track how the yield curve turns, and then you can easily project. Now, I believe additional growth is going to come in the issuance of Sukuk, not just from the debt management office, which I know is in the process of coming out with his fourth issuance, right? We've seen corporate issuances as well, but certain things are going to drive this issuance, right? As the non-interest banks grow, we will see the need for capital enhancement, and we'll see more issuances, right? We will see the likes of corporates needing money for expansion, for projects, for equipment, that are very easily able to be structured for Sukuk issuance, where we expect to see corporate issuances also go up. The drive for affordable housing projects, being that real estate is such a big aspect of the investment universe now, we would see the drive for that affordable housing, to drive Sukuk issuances by corporates and government-linked entities. Green financing, ESG, these are areas that are likely to also drive Sukuk issuance. And I'll say this, right? When you have a push for ESG investment or for green financing, and you look at the infrastructure opportunities in Nigeria, because I will call them opportunities, right? You see a very good synergy, right? Is it the acquisition of renewable energy equipment or the development of renewable energy projects? We've already seen this already been applied or being used in our market. It just needs to be enhanced. And obviously road infrastructure and other infrastructure, airports, your hospitals, educational centers, by the subnational and the sovereign are things that we think are also going to drive the growth of the Sukuk market. Now, it's also important to understand what causes some of the drags that happen in Sukuk issuances, so we can be well aware why the work of the Non-Interest Capital Market Committee is very critical. It is because everybody has considerations. The pension industry has considerations, right? The issuers of these instruments also have considerations. The investors have considerations. These considerations, all of them have to be met, okay? The issuers need to see that there would be tax neutrality. They need to see that costing is good, right? They need to see efficiency of a process, right? The investors need to see liquidity. So we have to make sure that all these things come together, and a lot of work is being done in this regard.
I agree on a lot of work being done, Darko. We'll need to hurry you along because we are definitely 30 minutes behind time. And I was thinking we could close this at 1. I mean, being a very long and engaging morning. So I don't know if you could just jump to your wrap up so we can get this, so we can just stay aligned so we don't lose people's attention.
Not a problem. Not a problem. And thank you for mentioning, as in your intervention was very well timed. This is my last slide, incidentally, right? And this slide is just to speak to all the growth areas in the non-interest capital market. So one is to develop a non-interest interbank that is very vibrant and builds, the money market, the kind of money market instruments that we would like to see, ensuring that there's a maximization of returns and we have short-term exposures. And I know within the Non-Interest Financial Institution Association of Nigeria, work has already been done in this area, in using Modaraba, in using Wakala contracts, to develop ways of mimicking or developing the non-interest interbank market. We've also seen efforts at industry standardization, which can enhance the process of investment appraisals. It can reduce the investment considerations to just commercial terms, because we know that instruments have been standardized. So this is a significant growth area that we see. And then we've also seen work being done on short-term sukuk. Now, short-term sukuk, be them in Yemen, Bahrain, the Gambia, and whatnot, are very significant investment instruments, right? They assist with the frequency of issuance, the repetitiveness. They work just like treasury bills. So if that appetite for short-term remains, if that appetite for liquidity remains, these short-term sukuk structures, be them on the basis of Mudaraba, Ijara, Salam, which structures are already in place or structures are being developed around, can attend to. And then obviously the issues of commercial paper. So these are a lot of things that we know will hit our market, hopefully in due time, right? To enhance on all the existing things that exist. I think I'll just stop on all the efforts, be them in awareness, that we need to work on. I like what my earlier speaker said. In terms of education, we have done some work in educating the investors. We have done a lot of work in educating market participants. We have done a lot of work working with industry advocates and things like that. But I think collectively, one thing that we must do is also work on transferring not just capacity, but transferring passion, right? If you look at some of the people that have worked hard, they are instrumental people in various institutions that have driven the non-interest capital market. Their passion, aside from their capacity, has to be transferred as well for us to continue to grow this market. I'd like to stop here, sir. Thank you very much for listening. I'm available to answer any questions.
Thank you very much, Ndako. I mean, I wish we could go really on and on, but I think the major thing is to set a stage. I didn't have a shred of doubt in me that the discussions was going to be this interesting, or should I say the exchange of information is going to be so interesting. I've been following up on the sort of questions that have been asked and the sort of responses that have been provided. Dr. Umar Farouk, I really must thank you. I see your prompt responses. I know some select questions have been directed to other paper presenters and other people that have been invited to the platform who have tried to provide responses. I think in the interest of time, because we are 30 minutes, like I said, behind time, all the other questions that may have not been answered or adequately answered, we have your contact details, which is in our database based on your registration for the event. They will be forwarded to the respective persons, and their responses will be passed on to you directly via your email. It will have been most beneficial if by verbal exchange of questions and responses, many more of us will have been able to take advantage of it. But that's what happens. Good things never last too long. I guess that's where we'll have to leave it on that note. And in thanking everyone, I'd like to invite Executive Commissioners, Corporate Services, Alhaji Ibrahim Boyi of the Securities and Exchange Commission, to give closing remarks and a vote of thanks to everyone. And before I pass on the platform to him, just to say that at the height of it, we got up to we're 330 participants, including all our speakers on this platform, and it's been very, very vibrant and rewarding session. Over to you, Alhaji Ibrahim.
Well, thank you very much, Dayo, and to all our participants and the panelists. I mean, if this was going to be a physical meeting, I'm sure the ovation would still have been resounding, because the quality and the depth of the papers presented, I think, deserves that kind of big applause. So I wish to thank everybody. I think I will start with, and forgive me for being maybe lacking humility, I would like to thank the SEC management, because, and I think it's a show and a demonstration of the commitment of this management to expand and develop the markets. And I believe this management sees a lot of potential of developing the non-interest capital market. And not only it fits with our capital market master plan, but I think we have also It's more like a kind of low-hanging fruit for the Commission. And I think that's why there has been a persistent and consistent effort in engagement with the various stakeholders to ensure that we achieve that. Of course, we have received in this March to developing and deepening this market the support of IFSB, led by our own Dr. Danbata. We have received enormous support and collaboration from them. And it's part of the effort to develop this market that they have lent their expertise and their special role in the non-interest capital market. We have heard how the market has developed from them, and of course, how itself, the IFSB, has developed. I want to thank Dr. Aisha Dairu, represented by Dr. Farouk, for the Goodwill Message and on her insights on the PENCOM's interest and the desire to allocate investments in non-interest capital products through the Fund 6. We believe that that is a step in the right direction. Our own Abbas, of course, when I was seeing the doctor, I am tempted to call Abbas a doctor as well, because Abbas has been a very experienced and an expert in a way on the non-interest capital market products. And he has explained and of course expressed the value of the partnership with IFSB, the FRAS, the AWOF, in terms of enhancing the governance on the non-interest capital market products. And of course, he has also explained the key opportunities that we see arising from the non-interest capital market. Dr. Farouk, thank you very much. You have provided some greater insights into the operations or the operationalization of the Fund 6. I think it has provided some key information to the market, and also for us as regulators of the market. It has provided some great perspectives. The suggestions that have been received in ensuring the realization of the benefits, I think will be important. Dr. Bashir, thank you very much. You've really taken us through on the key value proposition of the Sharia contracts, and have actually come to appreciate in the way you have presented these values, maximize benefits and removing harms. I think, sorry, in summary, this is what you have categorized the Sharia products to be, and I think it has fit in very well with the overall value proposition of the Sharia products. Ms. Abimbola, thank you very much. You've provided an operator's perspective to the Sharia products, and I think you have made some valuable suggestions with the way and manner the markets can be, that products can be introduced and the market developed. I note your particular recommendations on expanding the coverage of the market, and of course on capacity development, which this particular webinar is actually aimed to do. Finally, the last but not the least, Mr. Ndako Mijindadi for representing Mrs. Adeola. Ms. Adeola has been part of SEC in a way because she has the non-interest capital market committee. So we are not expecting any little less in terms of our submission. Again, he now provided a bit of more perspective on the local or domestic landscape in terms of the performance of the non-interest capital market products. And he also recommended, of course, continuous education, awareness, and adoption of technology to boost and deepen the market. So, Mr. Dayo, you have done very well in terms of your anchoring of this. I know, like I always say, that post-sec, we'll see you opening some event management center. So You've done pretty well, and I thank you very much. And again, I thank all the organizers of this event, our back office staff who have made this a success. And this is just a few of the continuous development in the non-interest capital market. And I'm sure very soon we'll all call you again for other sessions to further deepen and expand the knowledge of this important and emerging sector of the capital market. So everybody, thank you very much. And I wish you a great day. We're sorry it's taken this long, but accept our apologies. I think a lot of us will be ready to go further if we are allowed the time. So thank you very much, everyone, and have a blessed day. Thank you.
Thank you. Thank you.